Well, good morning, folks. Audio check. Bear with me a second here. Alrighty. Well, good morning, folks. Hope everyone's doing well. So if everything is as it should be, you should be seeing a weekly chart of the NASDAQ for September delivery contract month. Let me get my laptop where I can hold it better. All right, so we have had our economic news driver come out at 8:30. Whenever we have that report or similar like PPI, CPI, non-farm payroll, you shouldn't be trading that day. You should just wait for the opening bell and usually trade the 10 o'clock silver bullet. So if you're really forcing yourself to engage on that day, just for practice or just for the experience of it, just wait until the silver bullet for non-farm payroll. That's the easiest way, in my opinion, and it doesn't always equate to you're going to be winning, but that's the suggestion I would bring forth to you. So if you're an NFP kind of guy or gal, that's my recommendation if you're going to be trying to explore that. But I want to take your attention to this low right here. Okay, so on this candle here, on the weekly chart of NASDAQ, it's July 22nd, 2024, and this is a weekly chart. So I believe that low at 18,883.25, it could touch it because we have this sell side imbalance, buy side inefficiency. We're just about near it here. So how far can it keep pressing up into it? That far and as much, but I don't have a whole lot of faith in it as of right now. But the midpoint of that wick right there, which would be consequent encroachment. I like the fact that we had the candle close on this weekly range off of its low. The next week we open, we trade up, come all the way back down. So from this candle's close and this candle's low, all of that range is balanced and all the way back up to here as well. So I like to see some kind of stiff opposition to any forward run higher at the 18,883.25 level. Okay, so I would counsel you to have that level on your notepad. If it's on your chart, that's fine too. It doesn't mean it has to go to that level. It just means that, in my opinion, using a higher time frame, broad range observation, vantage point, I think that that's probably a likely scenario. If we look at the daily chart, we can see also that we are just about at the butt end of that candlestick low. So about 10 handles or so, thereabouts. So this big candle up here. So that's also something to look for. So we'll just call it the 50, what is it? I'm on the wrong candle, sorry. The 54 level, so 854. So 854 should be on your chart, and 883, we'll call it 884, just to round it up. Okay. And then dropping down to a 60-minute chart, really wonky type of price action in here. just keeps drifting higher. 15-minute time frame. This is a really random level in reaction off of that. It's probably some kind of a bullish divergence in some kind of momentum indicator. I'm certain it was probably something to that effect. I'm just kidding. If you look at the new day opening gap, you'll see that's the high. So if we're looking at naked price action, which we're going to try to do that today, okay, if we can just bring in the 5-minute chart here. All right, so we had our 8:30 news driver. It rallies up, challenges the London session high. So I'll add this. It'll populate all of my previous annotations. Okay, so you can see the new day opening gap high that formed last evening. Right there. Okay, so there is the close at 5 and then reopen at 6 o'clock. And since it's over 20 handles, sticking with the rules, the consequent encroachment level is annotated. So you can see how we traded back down to that level there and then rallied rather aggressively. Order block trades into here, rallies up, and we've pushed above the London high. So now I'd like to see it either try to make an attempt and fail. You can see all the other levels down here. You see all that? So I'd like to see it make an attempt to try to get to that 54 level and or the 84 level. And I'm in no hurry. But for the sake of looking at where it could potentially reach for, I was looking at those higher time frames with you. And by the way, I've gone through the comments. I'm pleased to see that you guys are enjoying the live streams and also seeing how the markets are respecting the things I'm covering before the fact. So that's how it should be. Never should be like just always market replay. You know, I guess there's a time and place for market replay for you as a personal student experience, but you're trying to teach what market replay, and it really just promotes the idea that you don't know what you're talking about. Because if you did, you would just simply do it with live data. And there's no argument around that. No one can argue themselves out of that. It's the way it is. All right, so all I'm doing is, we'll go 883.5. And that was based, obviously, like I mentioned, on that weekly chart. Then we drop down to the daily chart. The key level I'm interested in on the daily is here, and the weekly is here. All right, so now opening bell, we want to see if it can spike up into and reach up into these levels here. I'm not trying to try to promote any kind of entry idea. I want to see how, if it can, trade to that daily level or the weekly level, because they've already pushed it up a lot. I'm not interested in buying long. I'm not interested in going short yet. So I just want to sit on my hands and wait. And what I'm trying to do, Caleb, is since it's post PPI, post CPI, that type of report, in other words, after that report comes at 8:30, we don't ever try to do a initial high, initial low for liquidity's sake, into those types of reports, because those types of reports, as I mentioned yesterday and other times in the past, it's extremely manipulated. So, and because they're usually one-sided directional runs, I try not to have any concern right before the CPI number and the PPI number, because nobody has any idea what they're going to do. Okay, if I try to give you a directional bias and or it's going to reach here when it does the CPI or the PPI number, you would see that I'm more apt to be incorrect. So if that's what I've noticed over the last 30 years, I'm not having the ability. There's the daily chart objective to trade to. So now I want to see if we can trade it at 83.50. If that's what my data is suggesting, then that means that there's low probability for me to try to pick a direction, or pick a target, pick a liquidity. I just let them go in like a hurricane. You can't stop it. You can't stand in front of it. So just simply wait for it to do whatever it's going to do. And then after the storm passes, which is 8:30, once that initial wave of volatility comes in the marketplace, then you can go in and start looking for setups. Okay, what did they leave in the wake of that type of delivery and price? Initially, what I'm looking at is I like these lows in here. See how they're relatively equal? So I like that one. So we can go and start annotating that now, because this is our initial relative equal lows. So I like this. And we'll just... You may hear my puppies. I'm in the basement today. My wife's up here trying to troubleshoot with a tech with my son's computer. So, and we'll do bottom. And there you go. So that's my initial sell side liquidity. So I think this is a factor initially to study. It goes below this low here. We've already ran through it on the 8:30 news, then came back down into this buy side imbalance, sell side inefficiency. So you might question, well, why don't you just put your level there? Because I'm teaching my son to focus on relative equal lows and relative equal highs. And what I'm doing here is I'm waiting to see if they can form a relative equal high. It doesn't have to. It can go up there where it's at right now and fail and break lower, or it could go up above 83.50 and just keep going higher. I'm not trying to predict that type of price action, because I'm trying to build a idea around the 10 o'clock hour. So hopefully, our time together between now and 10:30. I do personally want to close it at 10:30 today, just because I want to keep it short. So hopefully by then, I can identify the silver bullet with you live. There's your 883, 84 level. So it's probably random too. When you have something like this, you screenshot it, and the key takeaways is this: forget the fact that it's the PPI number, forget that it's a PPI, a CPI, a FOMC. Label it, but you want to go back through price action and say, okay, from where it was likely to reach to and why. And then from that price point here, all the way to the beginning and the origin of the move, which is here, which is the new day opening gap that was formed at 5, and the difference between that closing price and the opening price at 6 p.m. yesterday evening, New York local time. Okay, and then you go back through and you study it. This is a 5-minute chart, so you can see we traded into an order block there. It rallied up. We have a breaker, trades there with a consequent encroachment. Buy side imbalance, sell side inefficiency. So there's a convergence of several PD arrays there, with the likelihood that it's going to run what? Here. Trades higher, comes back down, trades into the inefficiency here, rallies again, comes back down once more, trades into the rejection block, which is the down close candle closing price, trades there and expands through. Fair value gap forming here with an order block, an old high, fair value gap, trades to it, rallies to the daily objective I outlined, and then the weekly. Okay, so on the weekly chart, we have now traded and closed in that weekly fair value gap, or CIVI. That's this level here. So you might look at that and say, well, that was wild. Why didn't you take that trade? Because I'm not interested in chasing a run like this that's long in the tooth. That means it's been working, it's running. I don't want to try to get in the last portion of a move. Not to say that this can't go any higher, but you got to remember what's going on. Everyone now sees what the news driver did at 8:30, right in here. Okay, so that big run here, they want to try to get on board and run with that. And here's the opening price at 9:30. What's it doing? It's one shot, excuse me, tongue twister. It's a one-sided, one-shot delivery from open right to the weekly level I just gave you going at the opening of this live stream. So that's all I would be reaching for if I was going to go long anyway. So what I choose to do is I want to see, do they want to take it there? And then I can sit and relax and worry about what it's going to do afterwards. Because obviously the market's going to gyrate and move around, right? So we have to build some kind of context as to why we're entering a trade. And if it's so close, like if we're in here, yes, 50 handles is 50 handles. But it's chasing 50 handles at the tail end of, what's that, 200 handles. Okay, so you're trying to get the last piece of pie. And you know what they say, use your manners. Don't be the person that takes the last thing left on the serving table. I'm not trying to be the glutton that wants to catch every single move. I've hurt myself doing that. I kind of talked a little bit about that yesterday. I got a lot of feedback, positive feedback, about some of the additional content that I talked about yesterday, because I'm counseling my son on how to prevent toxic thinking, and also to kind of like balance the fear and greed aspects, and when you start getting success, and how to avoid the tilt when you lose control of what you're doing. And what that means is if you have a losing trade, you go and you start doing things that are not characteristic to what you initially were trying to trade off of, or abandoning your plan or trading opportunity or model, and just trading impulsively because you're trying to chase price, and you lose sight and connection with what it is that you're trying to do, and then you blow the account or create such a huge drawdown that's very hard to come back from. So like I said, I appreciate all the comments. I see them, but the people that leave the same comment that says, why no comments? That person gets banned. I'll never see a comment from you again. That means you either never listen to me, or you're just doing something stupid. And usually it's from people that don't even follow me. So I'll just burn them, get rid of them. But I appreciate all the positive comments and everyone's support of this new venture here. And Caleb, just so you know, that they're thanking you and telling me to thank you for asking to go into teaching you again, because that unselfish decision you made about making it available to them as well, they appreciate that. So anyway, that's the 5-minute chart. We went up to our price level here. I'm going to drop into a 1-minute chart now. Okay, so you can see on the 1-minute chart we have those relative equal lows, real smooth. I don't like this one because it went slightly lower than that one. Okay, if we can get through this and beyond that low, then my next attention would be right in here. See how smooth that is? That's also right before the 8:30 news driver. So I'm going to err on the side of, it could be just them pumping it up a little bit more and trying to get traders caught offside, chasing it, because it's been going up since last week. Okay, and I just remembered that I didn't show you what I was referring to yesterday. I said how we can use Monday when there's an expectation on my part, or anyone that learns my concepts and the way I internalize price delivery, is if I'm anticipating a 20 to 30% retracement on the present or previous week's range, if I don't get that type of delivery on a Friday, which is why I dubbed it TGIF, thank God it's Friday. If the candlestick for the weekly range is all one-sided, big bullishness, that type of thing, obviously it'd be one-sided because it's a single candle that makes it weekly. But if it's been predominantly one-sided, and last week was up predominantly for the indices, I mentioned in the live stream on Friday, talking to my son, I said, I think it has the potential to do TGIF. That means it could potentially reach into and retrace as much as 20 to 30% of the weekly range last week. But I mentioned yesterday in Monday's live stream on the 12th of August, 2024, that we didn't see it materialize. So when that happens, we can use that same idea and use the highest high that forms on Monday and anticipate that type of retracement. And while I'm talking, and we're not really doing anything yet here technically, you can go and pull up your weekly range, measure your fib low to high, and include yesterday's high, and notice where the low of the day formed. And also what also was there yesterday, what I was calling for, last Friday's new day opening gap. So there's a convergence and confluence of Friday's new day opening gap and also the 20% range of that entire, yesterday's high and last week's low. So that's the effect I was referring to. And that's why all the factors where I was saying to you, what are you doing when you're trading on a day like this? You got to do it early. And when I was starting the stream, I said, bear with me 1 second. I was putting my pups away and I hurried up and checked the fib level. And I saw that it was converging with that new day opening gap, which is why I was telling you to watch this. If it goes below the new week opening gap, it can go down to Friday's new day opening gap. And we watched it pan out like gangbusters yesterday. So anyway, I did not lose on purpose, by the way. I've teased a lot in the past, but I was generally expecting it, try to get down here and move in my favor, but I saw what was likely to happen, and good old Phil over there slid some dials to the left and the right, and then came back for the stop, which is kind of like what I said I was going to do. If it was going to get stopped at, I was going to go up and bump my stop. Everybody can see where my stop was. I'm sure everybody was going to try to trade with the same thing, which is the reason why you want to watch me live trade anyway, because you want to copy what it is I'm doing. And once it hit the stop, dropped down and went to everything I outlined yesterday real time. So it's important to try not to be in a rush after a PPI, a CPI number release, because you feel like you're missing the party. So Caleb, when you have these days, it's in my interest to see you try to not participate in these days, to be honest with you. There's plenty of time to grow into the aptitude to work and navigate in these types of days, but try not to put so much emphasis on being able to be successful navigating them. Now, it doesn't mean that you shouldn't be in there watching price action, logging it and seeing what it has done, and then using that as a means of building experience, reading it, and appreciating the level of risk that these types of days promote. That other traders or new startups, someone that's not really been able to find their model yet, they'll go in and they will. This right here is our initial buy side. So let me draw this out real quick. Other folks with less experience, they'll see this type of day and they'll say, well, I want to be a part of that and hopefully capture big runs and big money. And I'm going to counsel you to try to avoid that, because there's plenty of time once you have more experience to know with a great deal more, I guess, trust in your ability to see these big moves coming. And you don't really need the PPI and the CPI numbers to get these types of ranges. You just have to hold for the daily range. Okay. Over time, you'll learn that. So what I'm studying here is this wick right there. I'm watching the halfway point. Does it spike into it a little bit above it and reject, or does it completely roll over top of this high? And that should not be like that. Doing too many things at one time. Okay. So I prefer it to take out that high and then start to make an attempt to gravitate down to take the low here, and then work its way down in here. Even if it wants to go higher in the afternoon or continuously go higher, I would favor this type of action simply because it'll give us some framework to work within for the 10 o'clock hour. Okay, so we got about 14 and a half minutes before 10 o'clock, less than that for the 10 o'clock macro, which would begin in about 3.5 minutes or so. So 10 minutes before the top of the hour at 10 to 10. There we go. You got the run above it. Okay, so now we have relative equal highs after the opening bell. So we don't try to do any initial buy side or sell side on PPI and CPI number days. Okay, wait for the opening bell. If we can get the framework within the range of 7 to 9:30, we can go back through that range because they're all operating hours. Okay, you just don't want to look at anything prior to 7 o'clock because then you're going to incorporate London session price action, which kind of makes it a little bit more complex because there's a lot of different things that can inspire in terms of specific daily schematics or profiles, as I call them, like roadmaps, how the daily range will be formed. It doesn't mean that you're going to know exactly. It doesn't mean I'm going to know exactly every single day, but there are characteristics that tend to repeat, and I taught that on the mentorship content. So it's the private mentorship videos and core content lessons that I uploaded on this YouTube channel for free. Go into the day trading section portion of that, and you'll see what I'm referring to. All right, so we have had the buy side ran on relative equal highs post opening bell. And we have no run on sell side yet. It's just been one straight shot right from the opening bell. Here's 9:30, traded back down a little bit, rallied up. So when we're looking at price, and you know this, Caleb, because every time I sit down with you, I'm kind of explaining it to you. You're not trying to force. And what I want to do is I want to see if this gap here that we traded back down into, does it give that up? Okay, because if it can fail and go lower, this may be something that's influential for resistance. We're not trying to pick the top. We're not trying to call the top. We're not trying to call the reversal. We're letting the market tell us very clearly where it wants to go. We already shown 50 handle run off of a daily target and a weekly target. Straight shot to it. Just a beautiful illustration of what it is that you're trying to do initially. You're not trying to get entry patterns. Okay, you're not trying to pick the best stop loss location or where to move your stop loss. You're trying to get a feel for where the market could genuinely, and without a whole lot of back and forth type price action, where it can try to gravitate to. And that's the draw on liquidity. And that's the first thing that you're trying to do. And when you give yourself permission that that's all you're trying to do, it makes watching price action enjoyable. It's almost like meditation for me. And I'm pretty good at it. I can see it and pretty much know what it's trying to do and more or less when it's trying to do it. So there we go. We have a run again. And we'll see, does it want to keep that, or is it just disrupting everyone that's been watching the stream? One second. Forgot to put my phone on Do Not Disturb. It's a local number, so I don't know who that is, but I can't talk to you right now. But the same thing here. If we can trade lower, again, I'm not trying to buy it. I'm not trying to chase it. It's too long in the tooth for me. And what happens if it just keeps going up, ICT? Would you feel upset about that you missed it? It's like, say it runs 400 handles a day to the upside. I don't care. Because number one, it's going against everything that I have as a comfort, and knowing that this is what I choose to do. And what I do is I teach people how to be a buyer in discounts, how to identify discount. Anyone that's trying to go long in this right here is literally chasing price. That's the definition. That's the epitome of chasing price. And you're literally asking the market to take your head right off. And I've done that as a younger man, thinking, okay, I missed it. I'm going to catch the last portion of it and hope it starts to take off and have one of these big commercial bull markets that Larry Williams was talking about all the time. Because I thought every market that had certain characteristics were going to just go straight to the moon. And I got hurt a lot doing that. So I forced myself to wait for it to trade to either, some kind of opposing liquidity and then wait for a failure swing after that, or I look for it to give a clear indication that it wants to go higher after it's gone lower. So it has to go into a retracement that makes sense and goes to a PD array or a liquidity pool that I've already predetermined. So that way I'm not reacting to, not being responsive or impulsive to what it is I see in price, versus I'm waiting for something to come into my crosshairs, and then when it does, I'm going to pull the trigger because I know what I want to see happen. If I'm going to pull the trigger, I expect my target to fall to its knees and expire right then and there, not fight me and try to do battle with me for the outcome of that trade. I want it to just give up the ghost and drop dead, and then I know I have a winner and I can just manage it and see how much blood I can squeeze from it. Here, watching where price is right now, it can be rather uncomfortable because, especially if you're new, the natural impulse is it's going to keep going higher. It's going to keep going higher. It's going to keep going higher. And why shouldn't you just take a long? Why shouldn't you be taking this right here as resistance, broken turn, support? Because again, it goes against everything that I understand about price action. We opened up after rallying, since this morning. It's been going higher. We had the 8:30 news driver come out here, came back up, we retraced. We have these smooth levels here. This one here is possible. And right at the opening bell at 9:30, right there, that opening price right there, we opened and then rallied. We came back down, traded into the inefficiency between that candle, and then rallied. I don't want to be a part of that. If I can't be a buyer, which I explained to you why I wasn't willing to buy it before it traded to this level and that level, I'm not interested in taking that trade, because the probabilities for me and my personal style of trading, my way of reading price action, is not, it's not conducive for that for me. Okay, so while other people may take that trade, others may have went long and maybe have made money. Maybe they haven't taken their profits yet and they're expecting it to rally higher. If that were the case that we see happening today, that's simply just a move that I wasn't a participant in. I don't have a trade open right now. There's literally nothing going on for me. I'm waiting for more information. And my interest is how we trade at the 10 o'clock hour. Okay, that's kind of like what I'm doing. I want to see if we can give up this ground that we've made here and try to make an attempt to come back down here and disrupt this smooth little area here. I don't care what it does after that. Okay, so now think about what I'm saying. If I'm fortunate enough to see that unfold and I can outline it in front of you and walk you through it and it delivers, does that mean I'm going to go long or hold for short lower prices than that? No. It just means that would be the end of my interest. The exercise would be complete. My son would see what it is I want him to see. You get another illustration of what it is I try to do when I am not in like a quick, overwhelming, overkill hunting mode. This is me on a passive day where I'm not extremely interested. I have subtle things that I would like to see happen, and if they can materialize in price action, then I'll explore it. But I won't do maximum leverage. I won't do crazy pyramiding and stuff like that. It's just I would look for it to happen, go in maybe with one or two contracts. That way, if I can get a partial off on one and let the other one run to this objective down here. That's kind of like what I have in mind. But I have to wait for price to give me those, I guess, confirmations that it may in fact do it. Right now, it's still too early to determine that. Remember this gap right here? I told you that may be influential if we fail. We went up to the weekly objective I was giving you at the start of the live stream. We pierced it, and we pierced it once more. So we have 3 drives here, a 3 drives pattern, or if you have that book I recommended when we first started talking last week, and I've mentioned it other times in Twitter spaces when I was on Twitter. I'm not on Twitter now. I don't have a Discord. I'm not on Instagram. If anybody's on Instagram with my name, they're fake. Anyone on any other social media except for this YouTube channel, if you think I'm talking from that account and it's me running it, it's not true. It's somebody else that's taking my stuff and trying to pretend for engagements and whatnot. So they're all just pretenders. But if I'm talking to you, I'm talking to you from this YouTube channel or my community tab on this YouTube channel. So there's no other way for me to be confused with somebody else's, fraud. They're trying to be me, just using stuff I've already put up. And that book, Street Smarts, there was a little pattern in there, and they labeled it or named it the 3 Indians pattern, which was kind of cute at the time, but it's basically just a simple 3 drives pattern. It's funny, they don't ever get any flack about renaming something. I do, but my stuff isn't renamed anywhere. It didn't exist before me. But I do like patterns that have predated me, even before my birth. I'm 52, but a lot of classic stuff that happens in price charts, I like to look at them as a way of attacking it. And the 3 drives pattern is no different than anything else, like a bull flag or bear flag. I like to see those things form when I'm opposed to what they may indicate. So in other words, if you're expecting like a bull flag, I like seeing them and selling short right inside of a bull flag when I know that the probabilities are likely the market will go lower, not higher. And it's very, very satisfying to see that. It's also very satisfying for me to identify diagonal support or resistance and then target the liquidity that would be used in those instances. But a 3 drives pattern also can fall victim to that. And how do I avoid falling victim to a 3 drives pattern? A 3 drives pattern, just so you know, or 3 Indians if you want to use the title that Linda Rasch and Larry Connor's book, Street Smarts, utilizes or labels. It's usually when the market's going higher, and if it's starting to get close to a level that might be of interest to you, they don't go so much into detail in the book, the Street Smarts book, but I like the pattern because I did see it sometimes form where it tried to go up, made a higher high here, and that's usually when my stochastic indicator was being bearish, showing me a divergence. And I would many times look at that and say, okay, it's going to retrace lower and then give me a trend continuation divergence, which is like an indicator that has an oversold reading here, and then it creates a higher low, but the indicator goes lower than the reading it was here. So it's a type 2 trend following. George Lane did not create that. It's not hidden divergence because George Lane created it. It's Nick Van Nice. Nick Van Nice is the guy that gave the trading community the trend following divergence in stochastic. And George Lane gets a whole lot of credit for things that he really didn't earn. But that's enough being disrespectful. But it's not meant to be disrespectful. I'm just giving you a history lesson because that guy, he didn't invent it. Let's just put it that way. So I would get burned when I was trying to explore the idea of being a short seller, which made it hard for me because remember, I was also more prone to be a buyer because it made sense. Buy something cheap, sell at a higher price. In my initial foray into being a short seller, I liked the pattern of the 3 drives or 3 Indian pattern where it would go up high, higher high, and on the third high, usually, not always, usually it would start to trade lower. And you can get something like a measured move of the low that formed prior to the first high you make. And this is not in the Street Smarts book. This is the book of ICT talking. um, the low to the first high, okay, that low to whatever the highest third swing high would be. I would measure that, okay, and then what I would look for is I would look for half of that range to be traded to as an initial target, and then that low right there would be my objective. You don't see that in Street Smart's book. You don't see that in any book that talks about the three drives pattern. That they don't have that concept. It's not there. But that's the logic that I was using because I've seen that pan out more times than anything else. There are people that say that a three drives pattern where it's trading higher to three higher successive highs, then that creates the long-term top and it just continuously reverse, trades lower for a long time. Sometimes, I've seen examples of that, but I've also seen how many times these just create a intermediate term retracement to set up a longer term continuation moving higher. Okay, so while I like the idea of certain aspects of determining and measuring and anticipating visually what a reversal pattern may look like in price action, I'm more inclined to simply wait for the logic that I teach and have taught on the YouTube channel and in mentorship and in this mentorship here in 2024, where I'm trying to focus just simply on what's the next easiest likelihood of where price is going to go next. And it's very liberating to try to avoid being right about where the weekly chart's going to go and close, because I used to worry about that. I used to worry about where we're going to be 3 months from now. I don't have to worry about that. So I've disarmed myself as an analyst where I don't have to have, Olympic level results. And I'm trying to look for just where's the next easy thing. And when I say easy, meaning that it's easy for me to assume a position. It doesn't mean it's easy for you to see it just like I see it. And there's a lot of things that are going on in the market today, not just today, specifically the 13th of August. I'm saying that in recent years and months that the market has become faster, obviously, and that volatility brings with it a great deal of risk. So you have to know what you're doing, and just always going full bore, trying to accelerate to get to the next profitable trade and do more each time. We're not in that kind of climate. We're in a climate where you have to be very careful and try not to be so like 100 mile an hour. Just slow down and look for a nice, easy setup that makes perfect sense to your model, the parameters that you've made for that model, and it fits your personality. You're not trying to be something that you're really physically not able to do because you won't be comfortable in the model, as I was talking about last week. So we're in 10 o'clock now. Okay, and so far the market's still just pressing higher, and that's fine. I'm in no hurry to assume any kind of hardline opinion. And true to form, where I was saying, like, we have a high, higher high, and a higher high. Just because you see 3 drives higher doesn't mean it's going to reverse. It doesn't mean that you're going to get a nice sell-off. It just means sometimes that, if the market is heavily manipulated, and that's what we're seeing on a day like this, you can get ground down to dust. The market can continuously just keep grinding in one direction. And I genuinely don't like those types of days. And if I can see days that are starting to show those characteristics, it's very easy for me to say, you know what? I'm going to go watch a movie. I'm going to go read a book. I'm going to go swim. I'm going to go exercise. I'm going to go spend time with my wife, or I'm going to do whatever, But I won't watch the charts, because I want magnitude. I want swings that move around and gyrate. I don't want to be a part of a day that just continuously chips away and just grinds against a direction. I don't like that. I don't like to be in trades, even if I'm right when they do that. I don't like those types of days. So one of the things that you've probably seen over the years when I show examples, and I end up in trades where I am seeing profits build up, and it may be a trade that I've built a large position in, pyramiding it. I'm more likely to take a whole lot more partials along the way, because what I'm doing is that I'm managing my emotions and the psychological war I'm having inside my head that I don't like this, even though it's making the trade more in either pips or handles, and the profits just keep building up. I don't like that. I don't like being in that type of environment, because those days are harder for me to determine how far it'll go. And because I don't have the patience to just simply hold on to it and walk away, because I'm looking at every fluctuation in price action. I'm like, a kid in a candy store. If you let go of my hand, mom or dad, I'm going to go over there and start grabbing candy and shoving it in my mouth. I'm going to do that. Okay. That's my natural tendency. So for me to balance that, and for me to compensate for that type of wrestling match that's always going on in my head, if I am in a day where it's just continuously moving in my favor, you might think that, well, ICT must be chilling. Like he's just going to hold on to it forever. Actually, I'm not. Like I'm literally, I'm crawling in my own skin, because this is not what I want to see. I want to see it really start to run, and then give me some kind of additional entry point, even if I am beyond the point at which I can't, by money management rules, I can't pyramid any more new positions to the underlying position, making it bigger. And I taught that already in last mentorship. So I think it was 2023's mentorship. Or was it 2022? I don't know, but I know I taught it. I'm actually looking for a way to start scaling out of the trade. And there's many times where if I just simply would have just moved my stop one more time, just to be at peace with it, if it came back and stopped me out, and I just simply waited till 30 minutes before the close. So basically we're saying 30 minutes after 3 p.m., 3:30 New York local time, and then come back and look at the chart and see where I am, and then either take a large portion of the trade off if it's in profit, or to simply close it. I would make a whole lot more money doing that. But I can't live with myself while I'm in the trade. So that's what I'm talking about. If you have a personality that goes against the grain with some of the things I teach, it doesn't matter how profitable I can show it being, or anybody else, or a large number of traders. It just means that it's not a right fit for you. And there's nothing wrong with that. Just like there's a lot of other things out there that you can trade and you may be trading with, and it's profitable. It doesn't vibe with me. Like I don't have any connection to it, and I can't make that type of stuff work with me. So what I'm saying is there are certain characteristics in certain types of days in the way the price action is being delivered to us. Even with my concepts, I could be in a winning trade and still not feel comfortable in it. And because of that discomfort, I will actively look for ways to just start scaling out of the trade as it's moving in my favor. And then what will happen is it's many times like this. Later on in the day, it has this parabolic run. And if I just would have held on to the trade, I would have had a huge win because of that. But I'm generally not a part of that run, because I've wrestled with the personality traits that I have within me that goes against that. So I'm not comfortable. It's like it makes it feel like I'm long-term trading. And I wanted to be like a long-term trader when I first started. Like I wanted to get into a trade and hold it for months. And I discovered that I don't have that ability to be that patient, because I have so many opportunities to see different setups. I can trade long and short in the same day while it's going up. But it's harder for me to do that in days like this. So what is that highlighting? It's highlighting the fact that I don't have the ability to be nimble and trade both long and short in intraday price action. And if a day is trading like that, you can rest assured I've either been stopped out on a trade and not going to go back in again, or I've taken my position out, or I've taken partials off and then got stopped out. I'm not going to resume anymore, because I like to be able to buy and sell on the same day. That to me is an ideal technical day. If I can be a buyer and a seller and have range that I can use both sides, going long and short, that's like a playground for me. Like I am in my element. I will be all in that, just doing all kinds of stuff and taking all kinds of trades. But if the market just continuously grinds in one direction, even if I gave pre-market analysis and commentary, if I'm fortunate enough to be on the right side of the marketplace and be in that, I'm squirming in my own skin, because I don't know how to behave in that moment or in that trade in a mindset that's balanced. I'm wrestling constantly. So as I teach and I talk about the mindset aspects of trading and what you're going to be feeling when you start engaging price and you start seeing these things pan out, and when they don't pan out for you because you did it wrong, how do you cope with those things? Well, I'm telling you how I'm coping with it. I'm literally trying to find an exit ramp. And some days where I'm in it, it's like, should I just close all of it? Or should I take half of it off there? And if I start wrestling with half or all, then I just take one contract off and I see how I feel about it. Do I feel any more comfort from it? Or is it causing me more concern? I should have took off more. If I feel like that, then I'll take another partial off as soon as it makes a lower low if I'm short, or a higher high if I'm long. Right away, you should be looking at this gap right there and how we left it smooth. If it's going to drop, okay, let's say if it's going to drop, and I'm not saying it will or won't, I prefer it, but I would like to see it take it above these highs here and then show displacement below that low. If it doesn't do that by 10:20, my interest is done for the morning, and I'll kill the stream, and I'll be content with what I've explained and outlined. But if it continuously goes higher, I'm not interested. I'm going to close the stream, and that's kind of like what I'm getting at. I don't like days like this where it just keeps powering one-sided. And everybody out there that wants to find an opportunity to stand on their soapbox and say, well, see, ICT says this, and here's the trade I took. Well, if you did well doing it, I'd be the first one to shake your hand and say, congratulations. You did something that you felt comfortable doing. But I'm not out there saying, trade everything that I teach. And that's the problem with most of my students. They try to do everything that I introduce. And I'm not using everything when I'm trading. I'm picking one thing based on what I think the market's going to do. And if I don't see it materialize, or if the price action is not conducive for the things that I want to try to engage with, then I'm forced to either be impulsive and just go in at the gambler's mindset thinking, oh, well, this is what I really want to do, but let's throw that out the window and I'm going to just try to trade for the sake of being in there and doing something. Yeah, that doesn't make sense. So I have to know what it is I'm trying to do. What is it that I'm looking for? Why should it even be there in the first place? There's a whole lot more to it than just simply saying, I want to trade silver bullets. I'm going to trade, in the macro times. Okay, well, that's wonderful. But what are you trying to do in that 20-minute interval? What is you're trying to wait for? There has to be something, for you to be building the idea around. And right now, I have nothing except for whenever I talk about in price action, whatever I'm suggesting to you at that moment, that's the only thing that I see viable. And so far, we've had just the run above these relative equal highs. So we have that. Let's annotate this one here. Okay, but it would have to go below here because it's relative equal lows. It also would be a much more meaningful displacement. I don't want to just use this one. I want to use this low here. So I want to see if it can trade below that, maybe a little bit of retracement in there, and then we'll study and see if it wants to make an attempt to get down into this inefficiency and maybe even challenge this going into the lunch hour. But if we make a higher high, that'll close the stream for me. I won't be interested in doing anything more. Even if it were to trade lower after that, after I close the stream, it doesn't make a difference to me. I will be away from the charts. Even my private students won't even see me say, here's an example. I'll just simply close the charts and be done. Looking for my bottle of water here. So watch this level in here, or not level, I'm sorry, this gap here. Now I'm shading that, not orange, but it should technically be orange because I want to see, can it fail? I want this to fail. I want to see it trade below it, come back up and find stiff resistance on it and try to retrace into the daily range. That's what I want to see. So let me change the color so that way you understand what I'm doing, because I told you before, if it's ever this color, I'm expecting it to be an inversion characteristic to it. Whereas we see it here become a buy side imbalance, sell side inefficiency, and it trades back down in. If we were having a retracement and it traded down below these lows here and it did something like that, then I would look for it to go higher off of that. But because we've been one-sided, this keeps pressing higher, 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 higher. We created relative equal highs, and then we upset it like I was outlining that. I would like to see that happen. Then I want to see it reject. It just seems like they're trying to punish anybody that wants to be short, and they keep knocking them out. And then when there is no more sanity in trying to go short through the retail trader's perspective, that's when the market will go lower, because they are building liquidity when you do this. If it makes a higher high, I pull the plug and I'm no longer interested. Days like this, PPI, CPI, if they present these types of characteristics, I promise you, if you watch other folks on live streams that are YouTube live streams, you'll probably see them do their worst trading in those days. And I'm no different in that regard, because as a trader, we need fluctuations and gyrations and all that stuff, and just a constant march in one direction. If I'm not in that trade to be trading the whole daily range, and I wouldn't feel comfortable trading at 9:30 waiting for the market to create just this little bit of a little tail, that's the low of the day. Can it form like that? Sure it can. But I'm more inclined to say, okay, let it rally, let everybody chase it, and then break down, take out some liquidity here. And then if it wants to start going higher, then I'm okay with that, because we went to a discount, right? But you have to be comfortable identifying where your weaknesses are. And that's the point of going slow in the beginning and not using real money, not rushing to a demo account. You have to determine where your weaknesses and your frailties are as a person, as a human. And if you don't identify them and develop coping mechanisms and identifying how you're going to behave, how are you going to keep yourself from going on tilt, like I was talking about yesterday? How are you going to prevent yourself from blowing the account, from over-trading, or impulsively pressing the button because you're now in a daze? It's like the fog of war. When you're in trades and you tear yourself down with drawdown, trading is not a sport. It's not a video game. It's war. But much like anyone that goes through war, and I'm not claiming to know that, but my father was in Vietnam and he never wants to talk about that stuff. So it bothered me. I want to see how it reacts here. I like how it's doing that. Again, I don't want to see it trade above here. It can wick through that. That's fine, because we have this order block. It can go as much as the halfway point on the spike of a wick. But I want to see this area here maintain the bodies or resume and send it lower. But I've learned that folks that have had seen action, where they've been in firefights and they've seen the horrors of war, they don't like to talk about it. And the people that talk about it, oh yeah, I was in this, they're either talking out their ass, making up stuff, or they never saw it at all. But the same thing happens to us as traders. When we go through a period of severe drawdown or adversities where you just simply can't find your groove and the markets are hard, that tends to create this fog of war also, where we lose our bearings. We don't really know what we're doing, and we're shell-shocked. And that's why people in that condition, they go on tilt. Like they don't have the capacity to think rationally, because they're experienced horror, because they've equated the amount of money that they lost or draw down in their account, or the account being blown. They can't think rationally. That's why you'll argue with your spouse. You'll be more abusive to the people around you and more sharp and pointed with your responses, because you view them as another distraction or another way of bombarding you with more stimuli, and you're trying to come to terms with what you just put yourself through. And because you put yourself through it, it's easier for you to associate that pain and that overwhelming defeat as an external thing, or something else contributed to why it happened, when it's you that did it. So I don't even know why I'm on this subject matter, but on days like this, though, it's easy to get caught up in that because you're most likely going into this type of day, and if you're a live streamer, you're going to feel the impulsiveness to want to do something because your people are watching. I'm not John Q live streamer. Like I don't care if you come back and watch the streams. I don't care. I don't need to live on the money that comes from this stuff. I'm not here to try to impress you. I'm here to teach my son, and you're here just to either take notes and see if this stuff has any value for you or not. If you don't, then you won't come back. If you do, you'll keep coming back. It matters not to me. But to manage all of these things, and when do they occur for me? With 30 years experience, I've seen a lot of things in price action, and I know a little thing here and a little thing there that tends to work well. When do I put on the brakes and say, I don't really want to engage in price? What type of characteristics tell me it's probably not a good idea for me to take a trade? If that's the case, where we have a day like today where it's after a high impact news driver, and you already know the PPI and CPI number, especially because it's an election year, they are highly manipulating these reports. And it's also the Fed. The Fed's in this market, okay? And I said this years ago. I said it in 2016, all through Trump's, his presidency. They were literally just throwing money in here, and it's artificial. They're propping the market up. It's not. None of these stocks should be at these levels. There's literally no reason for stocks to be where they're at. They should have crashed years ago, but because people in high seats get paid for doing certain things. I just realized where I'm at. Let me shut up before the stream gets cut again. There's a high degree of motivation for certain things to take place, and the levels of manipulation, control, and rigging, like a casino on a riverboat in the old times. I gave this analogy before on Twitter Spaces, where they would have the roulette wheel will be rigged, and I told you how they did it. So everything can be rigged, everything can be gamed if there's money to be made in it. Okay, and obviously the biggest casino in the world is the stock market, and next to that it's the forex market. So all these things, when you look at the potential for the benefits of controlling the outcome, if you could find a way to control the outcome or manipulate it so heavily that an outcome is more likely to occur, you don't think there's going to be people that are going to have a vested interest in trying to see that thing pan out like that? So because that's my perspective on the markets, it doesn't have to be for you. I mean, you can go around and believe RSI and price patterns, push price around. That is what I'm thinking when I see one-sided days where they just keep grinding. They don't have any meaningful retracements. So I know I'm in an environment that's highly and heavily manipulated. So I know that the odds of me being, number one, accurate, two, feeling comfortable holding on to the trade, because I know at any time the market could just slip and reverse on me, whether I'm going short or long. And that I know that my first stop out on a day like that, when I already know, if I see the characteristics showing the signs that I'm on a day where this isn't my foray, like I don't, or forte, this is not my my strong point as a trader. If I get a stop out that is a realized loss on a day like that, that is like a multiplier that is extremely painful for me. That's a loss that I will beat myself up over. And that's why I tell you, as soon as you understand who you are, you have to bloom where you're planted. Try not to do things that are outside your comfort zone. You don't need to do anything outside your comfort zone, because if what you are doing has an edge, and you don't need a very, very big edge, you just need to be able to be consistent with it. But you have to guard that edge too. There's individuals out there that pretend to be influencers and trade educators. They'll say you have to push your edge when you have it. And I've always said that that's stupidity, because no one takes a sharp edge on a knife and constantly use it, and then never hone it, rest it, take care of the edge, because you can push yourself. I have lots of tools. I have lots of things that I can get into the market with. But I also know that as the operator, the person, the man that is going to be in charge and responsible for the outcome, because I'm pushing the buttons, I'm getting in the trade, I'm placing the stop loss and moving that stop loss, I have to assume all that responsibility. So if I know, and if I can identify an environment where I know I'm not in, I'm a fish out of water, if it's just a grinding one-sided day, if I'm not equipped to identify it early enough and have taken partials out and profited in that move, if I get stopped out on that day and I have already recognized that this is the type of day it is for me, those are the worst for me. That's the worst type of day for me, because whatever that monetary loss is, and it could be very, very small, in my mind, I will magnify that many times over because I didn't do what I have told myself when I was younger. As soon as I see this type of day, I have to know it, recognize it, and then start taking money off the table, because every single loss on a day like that when I was younger eventually led to me blowing the account, because I was trying to force myself to be in conditions that I was not comfortable in. And then I would make excuses for why, this didn't do that. And it was me. It was me that was doing it wrong. And it's a very hard thing to do when you're learning how to do something like this, because everybody wants to be able to fault something externally. You want to be able to say, oh, it wasn't my fault. You can't blame me, social media. You can't blame me, internet friends. You can't blame me. You can't blame, the person because that broker did it to me, or that, something external to yourself. No, you chose to put your stop loss there, or you chose not to use a stop loss, and you chose to buy that many contracts or that many lots if you're trading Forex. You're making those decisions, and you have to be responsible with that. So one of the biggest things you're going to have as a hurdle son is you need to find what those barriers are for you, where you're uncomfortable, and don't be afraid to identify them, and don't look at them when you discover what they are and say, well, this is a weakness, that means I'm going to fail. No, this is how you prevent failure. Because if you go out there on your strong foot in an area where it's quicksand for you, and you know that this is your kryptonite, this is your weakest stage to perform on, nobody in their right mind would do that. Nobody, a glutton for punishment, does that. But see, that's the very state of mind that every new trader and every student that comes to me with either preconceived ideas on what they think they're going to learn versus what they have to learn about themselves first. All of my successful students have gone through this process, and they have in one way, shape, or form communicated openly in our community as the individual user groups. They can see who shines in what user group and who doesn't. But the ones that are successful, they have been very candid about what they see as their personal weaknesses, and they don't feel any shame in that. And that's strength, because what you identified is, okay, I don't want to be in a condition, if you think of yourself as a Superman or Supergirl, Superwoman, and kryptonite is Superman's weakness. No matter how big and bad he is, okay, you put a cornflake with kryptonite on it, he's nobody. He's just the average person then. Well, as a trader, you have to identify where your kryptonite is, and every trader has kryptonite. Mine are internally. It's not that the market's beating me. It's I fall on my own sword when I don't identify where I'm at and what environment and climate I'm trading in. Go back and, well, you can't rewind. And by the way, I got a lot of people saying, I can't rewind the live stream while it's going on. I like to be able to pause it and write down my notes and all. Well, again, I'm not here for you. So, because my son watches delayed data, he doesn't have live feed, he doesn't have real-time price feeds, he has a delay. So when he's watching the stream, if I'm pointing to something, he knows that there's a delay of however many minutes. I don't know exactly how many minutes it is, but there's a delay. I want him to study. He knows there's something I commented on real time, so it's coming up, and I want him to practice seeing it materialize on his delayed chart. Okay, so he's not doing trades, he's not even demoing, he's just observing price action. To me, that's the best way of learning. It beats market replay, because market replay is, you already know what it's done. But I mentioned in here, just for the sake of our conversation here today, I mentioned how I wanted to see it could spike up with the wicks up to consequent mean threshold of the order block. Let me take all this stuff off here. So how far can it color outside the line of this this gap I was watching? Right there, which is the midpoint or mean threshold. It trades up to it and then dropped. So we went below this low here. I like that. I want to see it. I would prefer it to go one more time into this. Maybe tap the low of that candle there. It doesn't have to. But right now, I would like to see, let me clean this up. I would like to see it kind of like gravitate to these lows and these lows. So I'll highlight like this. And if you're watching, I want you to just relax, okay? Don't have high expectations. Don't demand that it's going to pan out, and don't be afraid if it doesn't, because this is an environment. I'm admitting openly to you, trying to show my son that this is where Dad doesn't like to trade in. I don't like to trade in these types of days, and I get a lot of questions all the time, like, how do you know when to avoid certain trading days, and what does it look like, and what does it feel like, and what am I feeling, what are my concerns? Everything I've outlined here. And honestly, you know, if you've been trading for a long time and you've made money trading, I promise you, in the audience, you're telling yourself that this is something that you wish you would have been exposed to sooner. You probably had to glean it from your own experience, painfully, right? I would have given my left arm for this type of teachings, because I didn't identify any kind of hardship as a way of determining where my weaknesses would be, so that way I can avoid them. And it doesn't make sense. Like, Larry Williams gave a really funny analogy, and I've borrowed it many times. He was referring to how, like, if, like, say you live next to a person with a white picket fence, is a blue house, and I'm kind of going by memory from my lecture, keynote speaker event he did, where he talks about, you know, you walk down this road and you pass this same house with the white picket fence, the blue vinyl siding and whatnot, and you see it's there all the time, and they have a dog that's ferocious, and it runs down to bite anybody that comes by and too close to that fence. And you walk by and you make the mistake of walking too close to the fence, and it bites you and tears into your arm. Okay, well, the next day you get up, you walk down there and do the same thing. It rips through the bandages and tears your arm open again. Are you going to do this 50 times before you get the point? You probably shouldn't walk so close to the fence. You probably should walk on the other side of the fence, take a different route. Don't do that, because that is a stage for you to do what? Experience some adverse reactions. So what I've done, and I didn't do it soon enough, if I was being honest with you, I've spent time in my first quarter of my development as an analyst and whatnot. I wanted to see where I was making my biggest errors and where it was easy for me to make errors. How can I mess it up? When do I mess it up? What are the types of climates and conditions in the marketplace that were prevalent, that were obvious, that were there all the time when I was creating these hardships for myself? And it's some of the things I've talked about here today. And have we moved around a little bit? Sure. I'm not going to argue that. Anybody could see that we've had some fluctuations in price action. But it is not clean price action, meaning that it's not going to obvious levels, turning around. I mean, I can talk about certain things, but you can see it's a lot of coloring outside the lines. And I had to tell you how far it'd be willing to go here. I don't like that. I want to be in a situation where I can see the expected drop and then have this level here and it not go outside of that. I prefer those types of climates, those days where they respect the PD arrays. and it's unable to do certain things when I would like to see them fail. Because I do want to see PD arrays fail. I want to see that because it gives me confidence that what I'm expecting for directional runs or where the market may draw to, it gives me confidence that that's still going to most likely pan out. And this is just small little, coloring outside the lines. All right, so right now it would need to start falling out of the bed and going lower if it's going to go lower. If it were to rally and go above this short-term high here, now that kills it for me and I'm done for the morning and it kills the session. But ICT, don't you want to trade? No, ICT would go and probably take a ride with my wife. I'll break out the 21 Corvette and paint drove it in a couple weeks. And that's what I intend to do. There's nothing wrong with that. It's just my way of dealing with an environment that I'm not interested in. Now, why would I pull the plug on my interest on this day if it goes above this high? Because we have these relative equal lows here that we swept down below, and it's probably going to keep going higher. I'm not interested in being long today. Well, you don't know how to you don't know how to trade bullish markets. Okay. Everybody has an opinion after I say something, but you're not bringing your live stream. You're not calling the market. You're not telling us what you're doing. You have the benefit of the sidelines and anonymity. What I'm trying to do is teach my son. I'm teaching him with real experience where I've lost real money and I've made real money. And the things that I've exposed myself that were barriers to me developing sooner, more comfortable, are the things of what I'm referring to here today. Which, in my opinion, if there was a way for me to talk about this, and I can't write it in a book because there's too many things that have to be referred to real time as it's happening. It needs to be a dynamic type of lesson. But these are the types of lessons that I can look back on with the experience I have and how many years looking at these freaking markets. If I would have learned these lessons sooner, or if I would have had someone tell me, this is the stuff that matters more than anything else. Because this is what wrecks you. This is what takes you out of the game. There's so many things you can do to buy and sell. Everybody has a technique to do it. Everybody does. Given the right conditions, anything can be profitable. Flipping a quarter can be. If you're look, well, when I first started trading, I got lucky being a buyer because the market was in a commercial bull market. That means it was going to go up regardless. And I was spending time trying to figure out what market to buy that would be better than the other, and they are all going up. So I had a built-in advantage, which I attributed to as initial skill, and it wasn't skill at all. It was literally me being blind luck. And that blind luck can exist for months. But when you no longer have the conditions that are predisposed to move in your favor, you'll find that nothing works. And that was a very, disenchantment. Because I was like, wait a minute, somebody's changed something around here. And it's because at the time I didn't know how to trade. I didn't really know how to trade. And I was just trusting indicators crunching the data for me. And that's all it was. Now, looking at this day here, okay, forget the fact that it's probably going to make a higher high, okay? Forget the fact that it's probably going to use that inefficiency and find some support off of it because we cleared the liquidity below here. And in my opinion, we're too far up here again. Today has not been, in my opinion, a day that is very easy. It's not clean. It's not a fast-running market where it knows it wants to go somewhere. So I'm not interested in pushing a button. I'm not interested in having a hard line decision. I would want to see, obviously I want to see it, trade down here. But for it to come back up here and create this run through and get that close to that high, what is this? Relative equal highs after it's taken liquidity. So the jaggedness is down here. Where is it smooth? Here. So can it go up here and bump that and then go lower? Can it go above here and then run right through this high? It can. So now think about what you just did. You nodded your head with me, As I was saying, both. What is high probability trading? The absence of one of them being true. Remember, high probability is where it's very, very difficult to frame the other side of the market going against what your trade idea is. If you can only paint the scenario that it's going to move higher and you're trying to be a long bullish trader, and it's very difficult, next to impossible, to frame any chance that it goes lower unless some freak price move comes in, and that's not likely always. Let me say that correctly. It's not potentially going to occur all that many times, but that always is a underlying risk that it can create some wild price action and spike move, a war type event, some kind of terrorist attack that can cause a shock to the marketplace. Years ago, we used to have surprise rate announcements. We don't see that anymore. And that's another reason why I know the Fed's doing things that he really shouldn't be doing. They're involved in the marketplace. They're in it. We don't have any kind of surprise rate cut, surprise rate increase. For some of you millennials, you have no idea what I'm talking about. But for the old heads in the audience, you know exactly what I'm talking about. And that stuff doesn't happen anymore. Everything's scheduled. So that means everything is scripted. So there's no chance for the market to be dynamic and a free market like we're lied to and told that this is what it really is, when it's not. It's not been a free market. As soon as Nixon took us off the gold standard, it's been rigged. But that's another conversation for another day. I don't have time to go into all that. But we have not seen anything in here that is quote unquote sexy and interesting. There's a interest for me to see price go to certain levels, but it's too muddy. It's too back and forth. And I have not obviously looked at my favorite live streamers and seen what they are doing today, and if they've done anything at all, or if they made money, or if they lost. I don't know that. Obviously, when we're done and I get a moment, that's what I'll be checking on. I'll see, what everyone else has done. But here today, I don't have any interest in being long, even though it could potentially make a higher high here. Again, if I wanted to, let me make the argument. Let's say that I wanted to see it go higher, which I don't care if it does. I don't want to do it if it does go higher. I don't want to be a part of that move. I would have to take a trade based on either half of this down close candle here or touching the top of that one. That means it's got to come back down and hit that. After it's done all this, to do that, that means we could trade one more time back inside this gap. It doesn't make sense for it to do that technically for me. If it's going to go higher, it's done enough here by making these relative equal lows disrupted. But I don't want to be long because it's been one-sided all morning and it just feels like it's petering out. There are times when it'll do these types of things and just keep, like I said, keep growing and grinding higher. I don't personally care about those days. And sometimes those days have several hundred handles. If you just would have got in and held on to it, that's wonderful. But that doesn't fit who I am as a trader. I don't have the complacency that's required to do that, because I've tried that before and I don't like it. I don't feel comfortable in that type of trade. And I want to be in an environment that has gyrations up and down. The market's moving very fluid, higher and lower. And it's very, very stilted in here. See how it's just like, it's being restrained. I guess that's the easiest way to explain it. So when I see price actions showing these types of characteristics where it just doesn't want to do very much, it's lethargic. It runs a little bit, then it comes back in a static, choppy little mess. Then it runs a little bit, and it comes back and does some kind of choppy little mess. The best lessons in your development as a student, whether it be with me or anyone else, okay, if you can identify these types of characteristics and signatures in the day that you're watching price action, these are the best days for you to say, you know what? I'm probably trying to swim uphill or upstream, and I'm not a salmon, okay? And if you want to be a salmon, think about what they do. They bust their ass swimming upstream to spawn, but then they die. So I'm not, look, Okay. I'm all for getting what you want to get, but there has to be some life on the other side of that, right? And in trading, guess what that means? You have to be comfortable and live beyond today. And we ran one more time up above that high after taking that liquidity. So I'm walking you through scenarios that don't really feel comfortable for me to engage, and what becomes problematic, what this may do, where is it likely to go because if it does this or does that, why won't I take a trade, what prevents me from being interested in the trade, why something falls out of favor while I'm watching price. Those types of observations when you're first learning, they're going to evade you because you're going to be so fixated on finding the right fair value gap or finding the right pattern or some kind of indicator setting or something that's made available to you. Whenever that's distracting you from actually reading the price action, you're actually deferring your greater understanding. And it's divided because you have the personal observations that you're going to feel while you're learning and developing. And also you're trying to also gravitate towards some kind of a approach or model that you're going to stick to come hell or high water, not change, not deviate from. And it's not easy. And that's the part that makes it very expensive. Not just with me, but no matter what you do in trading, you're going to find that this is it's a truism. It's something that you're going to have very, very sleepless nights and hardships dealing with. And it's uncomfortable, and you're going to want to find a way to get through it and get around it, and you're not going to be able to. You got to go through it. Let's take a quick look at the daily before I close this one up today. There you go. Jump right off the chart. All right, you see that little gap right there. The volume imbalance, rather. I mean, it is a gap, but this now, because of what it's done here, you want to have this on your chart. All right, and we will just highlight it with that. That's good. I don't really like yellow, but that's your daily chart. That is a volume imbalance, and that little separation. It's hard to see it when it's like that, right? But you have to elongate your price chart so that we can see any kind of inefficiencies and things like that. Let's go back into a 1 minute chart. Okay, see if that's immediate rebalance. That candle's wick here. In this instance, I wouldn't want to see this traded back into until it did this move up here. So this we want to see that remain open and then reach up into that little area right there. There's nothing wrong with missing moves, okay? In the beginning, you're going to feel like you're failing if you don't see every possible move, especially if they're moving quickly and if they have a sudden run and they move a lot. It's hard to wrestle through that unless you have somebody tell you in advance that don't place so much emphasis on that. Just relax and let it happen, because you're going to learn about yourself. You're going to learn about your model. You're going to learn where your strengths are in your model also. How do you build your strengths in your model? By identifying your weaknesses as an individual and avoiding those, because then what you've done is you removed the biggest barriers to your progress is going to be you and what you're going to do wrong and when you're likely to do it wrong. This is going to be one of the most not liked live streams, but this is the one that, in my opinion, this is the best one. Because in the beginning, you want to learn how to make money. You want to learn how to do the right trades. Not realizing that the barriers to you getting to that point is knowing the things that we're talking about today. Identifying problematic price action, problematic conditions, when you're not going to do your best. And for some of you, you might thrive in this type of environment. Like this might be your thing. Like where you're like, oh, this is easy for me. Like I can see this is easy for me to navigate this. Well done. I'm not saying that there isn't someone, and maybe, a large degree of my community, my own personal students can see these types of days and say, it makes sense for me to trade these days. But when you're trading those other type of days, it don't make any sense to me. That's not something to be ashamed of. It's not something to be embarrassed by. It's just simply you carving. And not everybody does the same thing for a living, right? Take yourself out of trading. What do you do for your job? What business do you own? Does everybody work in a tire shop? No. That's what my son does. He works at a tire shop. How you make your bread and how you pay your bills is your decision. How you do that. And the trading is the same thing. You got to find your own way in this. And not everybody's going to agree with it. But are you going to stop working and paying your bills with the income you earn from your job? Because, a number of people say, well, I would never do that job. Think about it. The civil engineers that come around and collect our waste, once a week. They call them the trash men. I'm sure when they were in college or school, they didn't aspire to do that, but they have to make their income, right? They have to make their bills, and that's what they're having to do right then. I wouldn't want to do that job. I'm thankful that they do it. But there's a time and place for everything, and what you're trying to do in the beginning is completely unknown to you. You don't know what you're going to end up doing as a trader, and you have to have some kind of a baseline. And avoiding or trying to ignore the barriers to your development, or the speed bumps, let's say it that way. When you have these moments where the market just seems like it doesn't want to do anything, every single time I put on here and click it, I gotta start looking at how many seconds away it is before it changes into another candle. Every single time I try to annotate something, it always moves right when I click on it. It's a conspiracy, I tell you. Let's see. The energy and the time you spend trying to avoid all the things that you are thinking that you're going to try to avoid, like losing, never having drawdown, only winning, only picking the right order block, only entering at the right time. That is a fool's errand. Like you're trying to do something that everybody will fail at, myself included. Okay. But because no one's sitting down with you when you're trying to do it and trying to coax you out of doing those types of silly stuff, you feel like you're going to be the exception to the rule. And I honestly believed I was going to be that way. And you're not going to be. And that's not a knock against you. It's just trying to tell you that instead of trying to avoid the things that are going to be problematic, try to avoid the things that are going to feel like it's harder than it needs to be. You need to grow into those periods and say, okay, I'm experiencing hardship in reading days like this. I don't know where the market's going to go next. It tends to be choppy and aimless, like a sailboat without a rudder. And then all of a sudden it creates these little runs that come out of nowhere. And then I get excited and I chase that one. And then it pulls back and goes the other direction. Well, guess what? That's what I discovered about these types of days for me. They didn't feel right for me, where every decision I was making about trying to engage with it was not correct. And then I would identify early on in the future those same types of characteristics in a new trading day. And the times that I ignored it and just pressed and plowed into it, trying to do what I normally do, I would get hurt. And I would draw the account down or do worse. And then I would take that pain mentally and psychologically, emotionally, that would manifest into physical depression, physical ailments that eventually started affecting my health. I would carry them into new trading days when my model would be there, and it would be obvious that my model should be implemented that day. But because I'm still beating myself up about not recognizing the previous trading session or the previous time that I lost on, when I knew that I was identifying this is a problem day for me. So instead of trying to force myself to perform, when I wasn't doing it in front of anybody, it was just me telling myself I had to do it. And I'm giving you permission to tell yourself you don't have to trade every day. You don't have to have a winning trade discovered and implemented and realized every single day. You don't need to do that, Caleb. I'm not expecting you to do that. I'm not expecting you to have a high win rate. I'm expecting you to grow a little bit, be a little bit better next week than you are this week. And I know by doing that, by default, you will increase in your understanding. And if you give yourself the opportunity and flexibility and permission to identify where you don't feel comfortable, that in itself is going to highlight where your model will be strong. And it doesn't feel like that in the beginning. It doesn't feel like it's going to work like that. But that's exactly what everybody, if you go back and look at your development, if you're profitable, go back and think about the things that you felt that were hardships. And by identifying them, and if you're responsible and you're mature, you don't try to sugarcoat them. You don't put blinders on or try to hide them from people. If you're going to have a conversation about your trading and your model, you have to be honest and say, okay, this is where my model's strength is. And these are the periods of time when it doesn't excel well. But see, that's the problem with the industry, because they're never going to tell you their personal weaknesses, because that's not a selling point. That doesn't mean, hey, this person should, let's subscribe to this guy's service. Let's buy this guy's software program. Let's buy this Signal service. Let's join their Discord. Let's join their mentorship. Let's join their anything. If they're not going to be upfront and tell you where the strengths are and where the weaknesses are and how to cope with those things on an individual basis, that's not someone that you should listen to. And I mean that wholeheartedly. And you can put anybody's name in that statement. I don't care who they are, because you're going to get your ass handed to you in this if you do it long enough. And how you're going to cope with that tells the story of whether you're going to be in it for a long term or if you're just in here just for a fling. You're here for an affair, a short-term affair. And affairs generally don't usually work out long term. You get something you don't want. And I'm trying to teach my son how to have a long-term approach to doing this. And maybe, he'll learn fast by doing it this way. Maybe he'll go slower. I'm not interested in how fast or slow. I'm just interested in consistently doing the same thing and growing in understanding. Because I know by default, the time aspect will do its job. He'll know more about himself. He'll know what makes him tick. What is it that you're looking for? Like, what is it that you're trying to trade on? Because if you can't draw out, and I did this in my private mentorship, if you can't draw out on a napkin at lunch today, pull out your pen, grab a napkin, and draw out with a line drawing what it is that you're doing to be a buyer or a seller. What is it that you're identifying in price action that your attention goes to in price? What is it that you're seeing before you press the button? And it's shocking to see how many people can't do that. And then they wonder why they can't find profitable trades. Because if you can't articulate in a very simple line drawing what it is you're trying to capitalize on, where your stop loss would be, where's your first target, and where is it trying to go to? If you can't physically draw that out, then how could you possibly articulate or expect expect to see it in price action if you can't articulate it in a simple line drawing. You ever think about it like that? For some of you, you're thinking, wow, I don't know. I don't really know how to describe it with a line draw. I can't draw it. And that's why you can't make money. That's why you can't keep a demo account without blowing it. That's why you can't pass a funded account challenge. That's why even if you got lucky and you got a funded account, that's why you lost it and you lost that funded account. Because you don't know what you're looking for. And when we sit down to a price action like this, I highlight things that I like to see based on numerous models. But if none of the models that I like and can implement are speaking in terms of, it's obvious this is what the market's going to do right now, then I have to sit still. And I'm going to let the market do whatever it's going to do, and it's going to do it without me. I'm not trying to make money off of it. I'm not trying to lose any sleep over having the right or wrong expectation over the marketplace because I'm live streaming in front of you. I'm telling you what matters more. Knowing and identifying these types of days, if it's against the grain for you as a trader, anybody that makes money, folks, I'll just say it like this. Anybody that makes money would not look at anyone and if they were honest in social media or if they were being honest in front of, someone in the industry and you met them for face to face, I would talk the same way like I'm doing right here if I met you. This is the reality. But anyone that makes money would never look at you and be condescending to you or say, well, you suck. Anyone that does that type of stuff, I promise you they're not profitable. And they're wearing a mask online. And the ones that make money would have a higher regard and respect for you if you spent time articulating, not hiding, not pretending it don't exist, where your weaknesses are as a trader and where your models are weak. Because if you understand where your model is weak, you can do things to manage and avoid those conditions that you have seen and measured by logging and journaling. And that's the benefit of doing it. I've seen so many ass clowns out there saying, I don't journal. That's the stupidest thing in the world. I'm in here to make money. Show us you make money. These are the same people that never show a trade. They don't even record it. They don't show it after the fact. They don't do nothing. But they always got an opinion. And the problem is because social media is so impactful, everyone, because they're trying to learn this and their confidence level in themselves is very low. And if there's someone pretending to be a very hard, very argumentative or a troll or something like that, or troublemaker, just a plain troublemaker, when anyone comes at them with any kind of adversity or any kind of sharp-toned response or say, well, you suck or this, that. Again, these are the same people that absolutely are fucking failing on every level, okay? But you tend to have a little bit more concern about those individuals because you're in a moment of weakness because you can't come back at them and say, I don't know what you're talking about because here's what I make, here's what I've done, and I'm going to do it live today, or I'm going to do this tomorrow, and I'm going to prove it, and let's see you do it. And then they run away, they hide, they clam up, and they've got nothing to say. But you end up taking the opinions or the concerns that other people have because they're miserable. And social media fosters this type of climate, which is the most toxic thing in the world for traders. You're inviting people in a conversation that never was invited. You didn't start trading so you can impress everybody on the internet. That's just one sub little thing that it's in addition to, because you want to make money. That's why you're here. You want to be able to make money. You want to be able to capitalize on moves and price action that repeat. And you want to be able to feel confident when you do it. But in the beginning, you're not going to be confident in the beginning. And everybody on social media is warring against other people. I have students now that are trying to talk shit about me because they want to garner attention around their mentorship, but they're teaching my mentorship. Make that make sense. The point is, do not invite other people into the conversation. Okay? Now, obviously, I'm allowing other people to hear my conversation with you, Caleb. But I don't care, because these people that listen to me, they can talk shit, they can make videos, they can do anything they fucking want, okay? None of that's changing anything. It's not doing anything. It's just putting a bullet point list of everything they are weak at. They're watching my streams. I'm not watching their shit. They're in here learning just like you are, but they'll never admit it because their ego's too inflated on no skill. They have no reason to be arrogant. They have no reason to be conceited or self-centered. They're failures. And they're the ones with the biggest bark. They're the ones with the biggest mouth. And they consistently are being exposed as a fucking failure. So don't invite any other person in your conversations. That's why the comment sections are not open on these live streams. I don't want you seeing any comments. And there's a lot of them, I'll be honest with you, there's a lot of them that are encouraging you along. And they're being very thankful that you asked to go through this again. And that you made it where you are allowing other people to hear what I say to you. But there's 2 or 3 that come in every day, and they're in there sucking themselves off. But they're from accounts with no content, and the accounts were just made. So that tells you that they're little dick energy boys. So if you're going to look at days like this and say, you know what, ICT says this is not his cup of tea, I'm going to go in and make it my cup of tea. Guess what? I ain't got no problem with that. I did that stuff in the beginning with Larry Williams. If he said he couldn't do something, that was like, oh man, I don't know where I'm going. That was my best inspiration, because it gave me a starting point. And all I'm doing by having these live streams with you, Caleb, is to give you a starting point on how to read price action, and then understanding when to sit still. When to sit still. Why does it make sense to sit still? And when does that change? When can we anticipate something that's measurable? Okay. When we were trading down here, I wanted to see it trade up into here, and this gap offer some kind of a resistance, because then that would have indicated that all of this was built in. It's like a premium. They pushed the price up and trap traders there, and now it should try to retrace to a deeper discount. And remember, I was aiming for this down here. This was my initial, and this is where I still think this is still plausible. May not need to do it today. It could be a response to tomorrow's data. But once we showed this move outside of here and we had this close right there, see how that closed above that? If I had a trade, okay, if we were trading short and I had used this area here as a stop, if it closed here, I would kill the trade. I would save the stop. Because if it's closing up here, chances are it's going to do what? It's going to come back down here and treat this as support. Go back and listen to the stream. You'll be able to see it in the recording. I'm not interested in being a buyer today. That's what I stated. And I said I would have to consider potentially seeing a stop that would have to go maybe into this gap again. And I'm not interested. It wouldn't make sense for me to have a trade like that. So if it's going to go up, it'll go up just by going into this gap here and reach for this high. And then we went back out to a daily chart, and I show you the volume imbalance. We highlighted it, and it went right to consequent encroachment, the midpoint of that right here. And look how it's behaving now. Off of a gap here that I said I want to see that stay open. Did it stay open? Yes. It stayed open until we traded up into that daily volume imbalance. So I don't know why my girls upstairs are barking like crazy, but they must see deer. Every time they see a deer, they want these things to bark back at them, and when they don't, they go crazy. The times in which we can see price action, I'll just kind of like say what I saw in a statement yesterday from one of the young ladies that are watching these lessons. I'm assuming it's a lady. The photo on their YouTube channel shows a woman. It's like a meditation channel and relaxation channel, and they put up content around relaxing. And she mentioned in her comment that she's just started watching in February this year, and she likes the idea and the approach that I'm using and teaching, and she can see the stuff panning out, and she's now already made progress in a funded account. So, and she mentioned how she's encouraged because she's able to help her children, and make her ends meet. Ma'am, I don't know your name, but I was half tempted to screenshot that and put it up. And the reason why I didn't do it is because when I support the women in our community, and not just my personal community, but when I support the ladies, jerks and perverts always take that out of context. Okay, like for instance, Tanya, she reminds me of my daughter. That doesn't mean I'm sexually attracted to my daughter. Okay, but if you watch her live streams in the chat window, it's very vulgar, nasty stuff that goes on and said to me and said to her. And I encourage her because she's a lady. Okay, and I don't want people coming to my channel thinking that it's just a man's world here. It's not. My best students are the ladies, and it's still true. My best student is a woman because she doesn't have a phallus. She doesn't have to measure up to anybody. She's providing. And that message that you left me, and I read it, is just true. And you mentioned you just started watching me this year in February. So you don't know that I've said that in years gone by, where women tend to be better traders because they're not trading for ego purposes. They don't win and go on the internet and say, ha ha, look at this. They're not barbarians. They're not gladiators. They do this to provide. Provide what? Provide nesting. That's what women think like, okay? Men are cavemen. We go out, we grab our club, we leave the cave, go out and bonk something over the head and drag it back to the cave, and we eat. We feed our families. Women don't think that way. They have to be much more careful and calculated. So if they're going to be out there fending for the family, they're going to do things in measured risk, and they're going to be cautious, and they're not going to go out there and flash it and say, haha, look at what I just caught and killed, and I'm going to go out, take it back to my house and feed my kids. You're being much more prudent. And your message, ma'am, was so perfectly illustrative of the very thing I've said many times. And the men, they take odds at that because they think that it's supposed to be like football. Like we're all supposed to like the same football team, or that ICT is a team. Okay. I'm a man. ICT is not a tribe. Okay. It's not a community. I'm an inner circle trader. I'm that person. And you take this content and you make it yours and you apply it to increase and build up your net worth, your legacy. You build a legacy for your family, a network that your children can glean from. And I just want to let you know that when I saw your comment, I was going to screenshot it and put it on my community post, but I was like, if I do that, number one, it's just going to open up another can of worms. I don't want people going to your channel and then leaving nasty comments because they're jealous. Okay, but just know that I read your comment, and I get a lot of them. I get a lot of them from women, and I want to encourage the ladies because sometimes how I talk, it's almost like locker room. Okay, I don't always choose I'm trying very hard today. I don't know if you noticed it or not, because when I ended the stream yesterday, I told the Lord before I started yesterday, I was like, try to keep me from cursing, because I don't like doing it. But when I get one side or the other on the spectrum, I get a little imbalanced in one direction or the other, and then I'll reach for words that I'm not proud of after it's done. And they're always in my recordings, even in the videos that you watch later on that were pre-recorded. I'm always talking like that because I get animated, and then I go back and I say, okay, say that again, but I edit that part out. But when I'm live like this, you shouldn't be listening to me or watching me when you're around your kids, because I'm probably going to say something that I wouldn't want younger children. Like I have my young niece living with me. So I have to move myself away where she can't be in earshot when I do this, because I know I'm going to use language that I don't want her to hear. So I know enough that I shouldn't do it, but I'm human and I mess up. So, and I don't usually use this language unless I'm talking about trading. I can go all day long. If I'm not talking about trading, I'll rarely ever use these types of words. But because it taps into a time that's very primal for me, where I had to struggle to get to this level of understanding, and I had to go through a lot of hardships, and it wasn't easy for me. So I feel like I'm back in that arena again. So it goes along with it. And there's a way to do this without doing that stuff. And the ladies, the women in my community, they tend to listen better than the men. And they go through the motions of identifying when I'm talking about where things are problematic, where they were problematic for me. It resonates with them because they don't try to hide their frailty. They say, this is where I'm weak at. And they don't view it as telling me it's a weakness. And therefore they expect to fail on the basis of that. They say, this is a weakness. How can I cope or overcome that or replace it with something else? And that's the reason why I talk the way I talk, because in my lectures, I don't want to just point to something technically, because having something technically in the chart doesn't necessarily mean that you're equipped to do anything with it. And then what happens if it doesn't work out in your hands? What are you left with? You have to resolve that some way, shape, or form. And what are you going to lean on? Your emotions, your frustration, as I was talking about yesterday. So anyway, I felt like I want to toss that in there because I get a lot of comments, and 98% of them are either saying, thank you, this is happening, or telling me what they've already learned and they're appreciative of it. The other portion is, why isn't there any comments? And or can you do Forex? And I told you I would mention and talk about Forex one time, but it's going to be towards the end. Okay, I'm not interested in trading Forex, but I know a lot of you are only trading the asset class. These things still work there too. So don't think that it's just a one-trick pony. My stuff, unless I tell you specifically during the lecture point that it's only specific to one asset class, it's universal. So just think about it as it's time and price is price. Doesn't matter what we're dealing with. If it's trading and it makes a chart, it's going to work off of this because everything is algorithmic. I'm just not convinced that crypto is running on the same wavelength. Let's put it that way. All right. So anyway, what you can do is you can screenshot where we talked about this level in here. And it created that little tiny institutional order flow entry drill. So in your notes, you want to have, whenever there's a fair value gap like that, that low, all it takes is trading one tick below that. And that when it does that, that's an institutional order flow entry drill. How would you use institutional order flow entry drill as an entry? Well, when you anticipate a gap staying open, but you think it may trade higher, in this case, trading up to this area here. So I drew all this out here, and I told you that I want to see this stay open. That means I don't want to see the difference between this candle's high and that candle's low. I don't want to see it trade down like this. In other words, I don't want to see this type of thing. Well, I'm not sure it's going to even let me do it, will it? Well, I don't want to see it do that, like come down and completely lay over top of that lower level line. I want to see it can come down into it a little bit, like it does here, maybe even trade down to the halfway point, which is consequent encroachment. But I don't want to see it trade all the way down into it. So if I ever am watching price action, and you'll see this in the live stream, so you'll hear me talk about it, where I'll say, I want to see this remain unfilled or left open. It's because I want to see it do this very thing here. And as soon as you hear me say this, this is where you write this stuff down in your notes, folks. Because you'll hear me say it again, but for the folks that are watching me do this for the first time, and they record it, and then they hear me say it again, it proves that it's the same logic. I'm not cherry picking things. I'm not making stuff up as I go. It's the same protocol all the time. But there are times where I want to see it close in because I want to see it fail. And that's something for your notes too. The inefficiencies that stay open are going to act like real support or resistance because this is acting as a breakaway gap. Why should I expect this? I know you're thinking, okay, so I get it, ICT, I wrote it down, but why did you expect it to stay open? Because I get this question so many times. And even in the lectures when I talk about it, like I'm doing here, I will still see, I almost said something rude. I probably will. I'm going to publicly shame you. I'm going to screenshot it and put now. See, you're going to do it now because you want your name to appear on my community tab. But I was thinking I'm going to shame you and show you that you're asking something I talked about in the very lecture when I talked about the very thing you're mentioning a concern about, which is I get this question a lot. How do I know which fair value gap won't fill in? Okay, if we were in a classroom and I said, okay, raise your hand if you don't know when to do that. Most everybody would probably raise their hand. And I get that same type of thing in the comment section. They'll say, how do you know that that fair value gap doesn't or won't likely close in? Like, what gives you that discernment? What makes you say that you can trust that? Well, we've consolidated like this here. And my attention was around this level here. Not enough to take a trade, but I wanted to see, does it repel this and start to break down? Before I go any further on that, if it would have started to break down, I would have dropped down into a 15-second chart, used the fair value gap, and outlined that down into the level I was looking for over here and then here. But it didn't give me that retrace back to it and break down because we're looking at it on a 1-minute chart. Then I could drop down to a 15-second chart and then use that and teach on the price delivery continuum theory. So all that means is, it sounds like mumbo jumbo, but it's basically understanding one time frame and then breaking that run that you see beginning on one higher time frame, in this case the 1-minute chart. I can drop down to a 30-second, a 15-second, a 5-second chart and find multiple entries in that delivery while that price run is unfolding. You're getting lots of opportunities to get involved in that move and still not technically be chasing the marketplace. But there's a threshold at which you got to stop. And if you've seen my lesson on pyramiding, when to stop adding to the trade and making it larger, it's the same premise there. Okay, so you'll see me teach on it. I know some of you are going to get mad because I didn't say it again, but I'm trying not to be too redundant, but there's enough redundancy here to prove that it's the repeating phenomenon in logic. But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation, all of this right here. Let me do it like this. All this price action here. We've traded higher since 9:30. Here, up, back down, trade higher, consolidating. Okay. I don't like these kind of days, and I would rather wait for more information or do nothing, because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. It's a lot of stagnant price action. Whereas when it does finally move here outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we leave the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. So what does that mean? You can feel, not today, not on a day like this, but you're going to see me talk about it on other days where there hasn't been a big PPI number or CPI number or something to that effect, where we move outside of a range and we have this same element here. This is something you can go back and look at your old charts. Maybe it's a trade idea that you lost on, or maybe you missed a move, or maybe you didn't know what the market was going to do, and you can go back and look at your old charts and see this here, and you'll see that they stay open, not all the time, but most of the time. If it's something like this and you anticipate them staying open, and you have a target up here that you think is going to draw price to, you can put this candlestick's low, your limit order, right at that candlestick's low, because then it only takes one tick to get below it to fill you long, and then aim for your target. Now this is like a bread and butter type setup where it's not a whole lot of movement, it's not a whole lot of range, but you can see we did trade all the way to the top of that volume imbalance on the daily chart. So this one, for the purposes and exercise of logging it, you want to make sure your charts all the way over the whole real estate of your chart. You don't want to have your charts like this, Caleb, because if I start seeing it, it's going to drive me nuts. The whole chart from the beginning of the move down here to the target, and make sure your chart is really filled up. And it's showing you a nice range that we can see the prices over here, and it gives you lots of places where you can write and annotate. Okay, but when it's open like this, you can use institutional order flow entry drills, which is a partial entry into a fair value gap that you believe strongly is not likely to completely fill in. Now, you will see these setups form, and you will enter with institutional order flow entry drill as your entry model, just like any other model, any other entry technique. Okay, but it's a very specific element of anticipating fair value gaps that you believe will not close up or fill in like in here. So if you see those, and I talk about many times in my examples, either audibly in like a review, or when we're watching recordings or tape reading, you'll hear me say, I want to see this stay open. When I was doing Twitter spaces and I was calling every individual 1 minute candle, I'd say, note candle at 10:47 a.m. 1 minute basis. Okay, NQ. And then I'd say, I want to see that one stay open or remain unfilled. That's the equivalent of me saying when we were watching it live down here, I want to see this one stay open. I don't want to see it fill in. And it doesn't. Okay? That proves there's logic there. That means there's something behind what price is doing that's causing me to say those things. It's not me just pulling shit out of my ass and just saying, hey, I'm going to talk and hear myself talk. I'm drawing your attention to something that I know with experience will most likely present this. Okay? Contrast that with all of everything else that was going on prior during the beginning of the stream. I was in observation mode. I want to see this. I want to see that. Because if it does this, then I'll have more information. I have no hardline fast. This is what it's going to do. Until we had that. Then I said, I want to see this stay open, and we're going to likely draw up into that daily volume imbalance. Is it something I'm going to trade? No, I'm not interested in being long. But ICT, it's moved up 30, 40 handles by now. Why didn't you take the trade? Because it's going against my comfort level. I don't want to take this trade. I can make all the points and handles I want just on Friday and not do anything today, tomorrow, or Thursday. That's the benefit of knowing that this stuff repeats. You don't have that. You think that every time there is something forming in price action, and I'm talking about it live, something happens in your head where you think this is the only time it's going to work, or this is the only time that I have the opportunity to use this information, and I need to hear him say this is a buy or sell. I need him to tell me where the stop loss, because you think that there's nothing else ever going to repeat in this. Like, this is the only opportunity, and the way you get past that is doing what we're doing here. Like, if you stopped watching the stream, you come back later on because you don't see any value in this, you clearly are not ready to learn. You're not, because this is the part that everybody has to do with me. And I forced my paid students, our live streams, or my live stream that I was doing with them, was me doing this with them. And the first group of individuals, I had people quit to the tune of like 150 people in the first 60 days. Because they wanted a signal service when I told them there wasn't a signal service. I'm going to show you characteristics in price action, and I want you to log them. And you're going to see over time, certain things tend to repeat. And the things I'm referring to in price action, you're going to identify on a personal level that it makes sense to you. Where other things you may not be all that interested in. And you filter those things out, and you work on whatever PD array, what specific principle of the price action that you see that is obvious to you, it's jumping off the chart. That means that your concern is around that very function in price delivery. And that is the beginning foundation to your model, your first model. It may not be the be-all, end-all that you retire yourself with. It may not be the thing that you make the most money with. It just means that that's your starting point. So I'm forcing Caleb into fair value gap because that's what I want to focus on, and it just makes it easy. Because if I got to go through this again with him, I'm going to do it where it's more comfortable for me, and it's up to him to keep up. But for everyone else outside of him, because he's my son, I can exercise the role of dad, even though he's in his mid-20s. I'm just going to say, look, I'm dad, and this is the way it's going to be. If we're going to do this, we're doing it my way. And for everyone else, just default back to what I've said many times in other lectures and mentorship teachings, is that I'm inviting you as the viewer, as the student. When you come here, you're not paying for the lessons. You do have to listen to things that are important. And the main takeaway is it's allowing you to find the best fit technically out of all the things I teach, which one makes the most sense to you. It doesn't diminish the effectiveness or efficacy of anything else that I use or teach. It just means that you're going to cut to the chase. You're going to get right to the point, kind of like what most people want me to do when I'm teaching. If you comment and say I talk too much, I broom you in the comment section too. I never get to see your comments ever again, because if you're rude enough to say shit like that, you never get a chance to have my attention. So for you, because I'm so interested in teaching you every facet to what it is that's going on in the chart and how to focus in on what you should be doing individually, but me having no impact on that, you have to determine what it is that you like. I'm going to walk you through this price run and show you how many examples there are that you could arrive at. So that kind of gives you like a baseline. It's okay, now I know what he's talking about. So now I'm going to start doing those things and start seeing the gravitation towards one PD array. Don't try to force yourself into it because I said I'm forcing Caleb in it, so therefore that's the secret sauce. No, you might be doing something entirely different, and I'll show you what I mean in a moment. But for the sake of the discussion, you want to be able to present yourself with that opportunity for you to pick what it is that you see by nature, by the very fact that you're watching price action and I'm commenting on it, and this is what I think the price is going to do, and this is what it shouldn't do. When I say those things and the price starts to march to a specific level, and if you see something that I teach as a PD array, I'm probably not going to key up a whole lot of interest around it because I'm forcing Caleb to look at the gap, hence this one running to here. That from here to here, that's all I would expect for Caleb. That's it. And we waited until 10:52, which is inside the macro for 11 o'clock, 10:50 to 11:10. There's going to be a run on liquidity or a run to inefficiency. I'll walk you through that macro before I close this one. But the idea is you want to see where does your attention jump to. Even if I'm talking about price action and I'm referring to something, your attention may go right to something else that I teach, like it's an order block, a stop run, like this here, institutional order flow entry drill. For students of mine that know what an institutional order flow entry drill is, like my private mentorship students, as soon as I outlined the fair value gap, you probably already saw that before I even started mentioning it. But anytime I say a fair value gap or an imbalance should stay open, what I'm saying is this is for your notes. If it's something that's acting as a premium array, meaning that it's trading up to it, which is the opposite of this, because we traded up and we're trading back down into it. The most sensitive area in that fair value gap is going to be the midpoint to the high of it here, which is this candle's low. So even if it did trade down into it, if I'm wrong about it not staying completely open and it trades down to the low, it matters not, because I'm going to get filled either at that candle's low or just above the consequent encroachment or midpoint between the candle's high here and the candle's low, so halfway in between. My fill will always be in that area. I am never trying to get a fill at the low end, because I've seen many times that the market won't go down there. Or if it goes down there, it won't fill me because of the spread. So I'm not trying to frustrate myself. So I want to get in with the low-hanging fruit opportunities of entry, the low resistance barriers to entry. That means the easiest one that the spread won't be a factor for. I won't have to be perfect. I don't have to demand precision. Okay, to me, this is precise enough. Knowing that if I believe that this gap is going to stay open and have some measure of openness that's not completely filled in, what am I saying by default? I'm saying that halfway between this candle's low and this candle's high, halfway point, which is consequent encroachment, it's going to go no lower than one tick below consequent encroachment, meaning that I have to find a fill if I'm going to go long at that midpoint to this candle's low. There's nothing wrong with going one tick as your limit order above this candle's low also. That really assures that even if you just book this price low, chances are you're probably going to get a fill. Worst case scenario, if it goes one tick below it, then you should have no problem getting filled. But I've been in the market with real accounts with limit orders where the market has spread 2 ticks beyond my limit order and it still did not fill me and it ran without me. So it doesn't guarantee that you're going to get in, which is why I always try to use and teach low-hanging fruit objectives for targets, and the same thing happens for entries. We're looking for the lowest resistance or barrier to getting in trade. So if we believe that this is going to stay open, Caleb, where would you place your limit order to get in as a buy if you're trying to aim for this volume imbalance as I outlined before it traded there? Is it going to be you're using that low as your limit order, or are you going to use one tick above it and just feel comfortable with absorbing any of that extra drawdown, being willing to see it trade down to the low, because it could spike down there and do that and still trade up there. But your stop has to be below this candle's high. So the risk is defined by, okay, let's say it like this. Look at this value up here, okay, right above where I'm showing you my cursor. That low is 18,931 even. So your limit order could be 931.25. So if it books at 931 even on that candle, as soon as it does that, it should fill you. But it might not. That low comes in at 929 even. You're getting filled. You're literally giving it 5 ticks, or no, was it more than that? 31? 9 ticks. You got 9 ticks. 4 ticks makes up a handle. So it's 9 ticks traversing in price. So you're absolutely getting in there. So what is a low resistance barrier entry approach to using that institutional order flow entry drill? And that sounds like a whole lot of stuff. Sounds technical, doesn't it? Technical science. How about that, Anton Creel? We're not talking about technical science. You might not be talking about that over in Goldman Sachs, baby, but over here, it's technical science. Okay, but I can't believe you just talked about Anton. He's my hero. So this entry model here, you have to anticipate, expect, and welcome and afford yourself the amount of drawdown that could take place, because it could come down here and touch the low of that. But in my mind, because I've been doing it long enough, and you will discover this too over time, that the market is controlled algorithmically. And because of that, these types of events are true if you're correct. And let's go back on that for a second. No matter how you trade, before you enter a trade, you have a religion. You have a faith-based model that what you're pressing the button on, you have faith that it's going to do something because you believe it will. Okay? I don't have blind faith. I have data. I have statistical probabilities that over 30 years, I've noticed these observations tend to be more apt to be correct than they're not. And I've transferred this information and logic and process and guidance to other people all around the world in different walks of life, and they are able to take this information and make money with it because it repeats. Okay? So if the markets are not algorithmic, then how do you explain that? These are very specific elements. Nobody, Chris Lloyd didn't talk about this. The guy he learned from doesn't talk about it. It's not in books. I mean, it's all on Amazon now with my name and logo all over it. Repeating everything I talked about in lectures, like this one. A lot of things I said in this one are going to be in books on Amazon. But it's probably going to be one of the better books because if they do it verbatim, You're going to have a really good psychological book. But that's it. He just gave me the permission to write a psychology book, ICT psychology. Whatever. The lower portion of that gap, I'm not interested in seeing it trade down there. But guess what I'm doing? I'm affording myself the flexibility. Should it do so, it would not freak me out if it's a day where I'm willing to be long. Okay? So Caleb needs to determine if he's going to use the low of that candle when there's a likelihood of a gap not filling and it trades down into it. Okay? The best fills are going to occur at the midpoint, which is consequent encroachment, to the high of that gap. And the least probable fill is going to be in the lower half because you're probably not going to get filled. Why? Because this gap formed after leaving this consolidation. So therefore, this gap should behave. It should behave as a breakaway gap. It's breaking away from this consolidation. See, but the folks that listen to me or watch what I do, they think it's either supply and demand because I'm drawing rectangles and over certain specific candles, and it's not supply and demand because supply and demand is a fucking myth unless we're talking about commodities, because that's a real thing. That's a grocery store of the world. There's real supply and demand factors in that market, but everything else is not supply and demand. It's controlled. It's controlled. Now, I guess to some degree commodities are controlled too, but there's real supply and demand factors with commodities. There's really no need to be buying a share of stock. There's really no need to be buying gold. It's a perceived form of money, but that's getting ready to be zero too. You know, when the Lord comes back, and I know you don't care to hear about this, but he's coming back soon. When he does, your silver and gold is going to be cast in the street because it's not going to save anybody. Wealthy people in the last days are not going to be comfortable. They're not. Okay, that's why I plan not to be here. So watch my personal YouTube channel if you want to know more about that. But this leaving of that consolidation, you're breaking away from that. If it's not supply and demand that people say I'm trading with, they're saying that I'm trading support and resistance. So if this is the resistance here, why didn't it come back down and touch it? Because it's not support and resistance that makes markets go up and down. The elements of this inefficiency, identifying it, as I mentioned in the live stream, you'll be able to you'll be able to rewind the stream when it's done. When the session's ended, within 5 minutes or so, usually I have to grab a drink or something, and then I'll go into the settings and I'll add it to the playlist for 2024 mentorship. If you have bookmarked the playlist, every day when the live stream's done, you can find that live stream that was made that day in the playlist in the order of their production. So that way you can go back and listen to everything and do all your note taking and whatnot. But the breakaway gaps, okay, when I'm referring to anything like this where it's not likely to fill, that's your key. That's your okay, that means institutional order flow entry drill. Okay? Unless I say that this gap should stay open or unfilled, you're never looking at institutional order flow entry drill. That's not the go-to. Now, let me backpedal just a little bit for the folks that like this idea, because you might think, okay, well, I'm going to use that as my entry technique, and even if it's a fair value gap that I may not say I want to see it remain open. There's nothing wrong with that per se, if that's your entry model. If I'm building a position and say this gap is larger, okay, say it's a little bit wider, I will use institutional order flow entry drill as my first entry, 6 contracts long, and it may dig down into consequent encroachment or the upper quadrant, and then I'll add 4 more. And then if I really like what it's doing in there, or if we enter in between, say it like this, say it goes in at 10:47. Say this time was 10:47. And then at 10:49, it went down into consequent encroachment. And then at 10:51, it trades down into 1 tick below consequent encroachment. I'll add 5 contracts on that one. Even though I'm underwater a little bit on the 6 contracts and underwater maybe a tick or 2 on the trade that I added 4 on, that would be 10 contracts. Then I can go in with a 5 lot when it goes to one tick below consequent encroachment. With the same assumptions that this lower portion is going to stay open, I've built in a position, okay? But what I just described, you won't be able to do that with one particular funded account company. Like, you can't add, they call that averaging in. And it's just building your position. You can avoid that by just simply not doing this type of trading. Just do one entry, use your institutional order flow entry drill as your only entry, and then add your trade, pyramiding in at a higher place. Okay, like this order block here, this order block and fair value gap here, all those subsequent later and higher PD arrays. You can participate with that particular fund. And you know what I'm saying, what company it is. I'm not going to mention them here because I don't want to sound like I'm an affiliate or repping them. And the only reason why I brought up Top Step is because Caleb said that's the one he's going to use. Okay, so it's not that I'm trying to funnel anybody there. That's not the point. But I'm sure they're probably tickled that I'll keep mentioning them. But, if he has a bad experience, you'll hear about it. So the institutional order flow entry drill is more specific to when we like to see a gap stay open. So if it does get below that low and enters into it, the underlying assumption is that you think that this is going to somehow remain the lower half open. Okay? Some portion of this gap between these two candles isn't going to be completely overlapped with sell side delivery. That means the market moving lower. If this is not your cup of tea and you can't see that, okay, then you would be trading order blocks, okay? And that would be this candle right there, and that candle right there, and that candle right there, because all three of these candles are all one order block, meaning that this order block, it's not just the last down close candle before the run up. These three consecutive candles are trading back down into this gap that has already been primed to send price higher, and we're just getting one more visit here, and then it trades above it, and it comes right back down and digs into this entire range here. See that? So if you look at it like this, can you tell I'm having fun today? I was supposed to get out of here at 10:30. What time is it? It's almost noon. I had some people complaining, can you make your videos shorter? I can't watch all this. I can't help you, man. Go watch somebody else. Go learn from somebody. Go watch the 5-minute trainer people and never make any money, never learn how to do it. This open price, all part of these consecutive candles, okay, that open price is the change in the state of delivery. That means the algorithm sees these three candles and goes right to that opening price. What makes these three candles the order block is because we have a fair value gap down here. The momentum is shifted higher. This should stay open, trades down and touches the top of it, and starts to move higher away from it. It does so, okay? When this candle's open price, when that is breached, that validates this order block. Think about what I taught you yesterday in the live stream, or how my entry mechanism was for the initial entry in 6 contract short on NQ. The same logic is being shown here, just reversing it. Now, look at that opening price through all of this back and forth price action. See that? I'm not supply and demand. Okay, I don't give a shit what anybody else says. Sam Seiden seems like a pretty nice guy. The few video clips people sent to me said, you took this video. Bullshit. This is not supply and demand. I'm cutting through candles. I'm labeling an order block based on a supporting PD array. It's not a be-all standalone type thing. It's never, an order block is never an island of unto itself. But when you watch these multi-level marketing shitheads, okay, these 20-year-olds that talk like me, they talk like me, and they promote these ideas and understandings that are incomplete because they don't know what the fuck they're talking about. See, there we go again. Let me dial it back in. Forgive me, Lord. I'm trying. When you have this opening price, you want to extend that to the right and then study how price respects and deals with it. The wicks are always allowed to do the damage, but look what the bodies are doing. The bodies are staying in the upper half of the bodies. The bodies tell you the narrative. Okay, so if you take that range, let's do it like this. Let me make it a little bit taller so you can see what I'm referring to. You're getting lessons on order blocks and didn't even ask for it today. Some of you asked for it, but that's not why I'm doing it. It's just I feel like teaching today. So we have the body on the open down to this close on the lowest down close candle. That range, okay, that range is where the narrative is going to be seen. You're gonna see what, if this is an order block, these things I'm going to show you right here, they're going to be present. Okay. Extend that forward. The body stops right there at that open. But what does the wick do? Trades down. This candle's an up close. It doesn't matter. It doesn't mean anything. This candle trades down into the open plus a tick or two, and then trades higher. Then we trade down again. What is it doing? It sends the body into the upper half between that candle's open and this candle's close. That red line. Look at what's going on there. Where are the bodies of the candles? Any down move back into that range, where are the bodies? They're in the upper half. So you don't have to sweat picking the best entry. If you know what my order blocks are, and you really won't know everything about them until the books come out. When are you releasing the books, ICT? I never realized that writing a book with, I guess, the community I have, and trying to get them to do what I want them to do. Like, I want to cover the way I want to cover. And they're like, well, you know, your percentage is going to be lower for this. It's a lot of bickering back and forth. I want what I want. So I understand you want anything. You take it as a rag if I gave it to you because you just want to learn the information. But I want my first book to be a specific way. So we're kind of arguing about what they're willing to do and what I want done. And if it doesn't work the way I want, then I'm going to use another publisher. Not that I'm going to be a New York seller's best list type thing, but what I want is what I want. So the opening price, extend that through. You can see all the bodies are working inside that, but the wicks are allowed to do the damage, but they're never piercing the body's low. See that? And then over here, what time is that? Oh, it's so fucking good, isn't it? Isn't that delicious? Look at that. 11:10. What do you think's happening right there? The algorithm that most people don't want to believe. It opens, it sends the price down into that opening price right there. We're cutting through candles, Sam. We're cutting through it, okay? There's no wipe off here. But that opening price, that's the sensitive price point, and that's the change in the state of delivery. Meaning that right there, any return to that price and or into the upper half of that consecutive down close candles, and I know some of this is going to be very confusing, especially if you're brand new. Because when we were talking about fair value gaps, you're like, I get this, this makes sense. But this is just for the folks that have been around for a while with me. And they've seen me talk about ICT order block. And they've talked about it in other circles where, you know, it's this, he talks about this down close candle, but it's not always this one. But when he's using consecutive candles, what's the theory? This is the first time I taught this. My private mentorship students never seen this. Okay? Like I'm here to teach. If you don't want to learn, you don't need to be here. But you can't deny that right there and the time it's forming, Dave. Because it's all time. Time. So here is the first trade in delivery inside of the fair value gap. This is the PD array. At 1050, the algorithm will do what? It will seek inefficiency or liquidity. Okay, well, we have a gap. It could act as a breakaway gap. We expect it to trade down into it, but not fill the gap in. Wonderful. What time is that actually occurring? At 1052. Does it meet the criteria for a macro? Yes. So the time this is forming, it meets it. So that means the market should start to gravitate where? To liquidity. Here, and where I took you to the daily chart. Because if the market's going to move, it's going to move to something on the daily chart. It's not just 1 minute charts. There's got to be some kind of higher time frame premise. Then if you build that in relationship to what you see on the smaller time frames, you have the best of both worlds. But the inefficiencies on the daily chart, or the stops or liquidity that's being either engineered or engaged, traded to, booked to on the daily chart, all of the things that make the world go round in the financial market, the key premise and levels are going to derive from the daily chart. It's the previous day's high and low, the previous day's high and low in the last 3 days, last week's high and low, the upper quadrant, the midpoint, and the lower quadrant of that range. Those are always the levels that you need to have, and that is not classic support and resistance. Okay, these are reference points that the algorithm will always go back to. I don't give a fuck if you're talking about Forex. I don't care if you're talking about bonds. I don't care if you're talking about gold. I don't care if you're talking about any of the indices, anything. That's what it's going to do. If it's running on an algorithm, those are your key reference points. And you're probably like, man, I can't wait for him to put the recording up so I can rewind that and get that again. It'll be there. But here's the 1050 to 1110 macro. And if you're a first-time viewer and you don't know what that means, every single 60-minute interval, okay, every 60 minutes, every hour, okay, at the top of the hour, the market will spool. It means it jumps and runs to one of two things. It will go to a short-term low to tap into liquidity, that it would be sell stops or sell side liquidity, or it goes up to a short-term high, which is buy side liquidity, or engage buy stops for the purpose of introducing liquidity to the marketplace, or it trades to an inefficiency to invite smart money to capitalize on an entry right before price spools to the liquidity. So in case you missed it, the inefficiency I identified as it was forming, I said, I want to see this stay open, and I drew your attention to that volume imbalance on the daily chart. That's all you need for a trade, folks. You don't need to be in it doing all this. You don't need all that. But remember, I was telling you like how it's just going to keep marching around. These are days that you're going to get beat up, and you might know a lot of stuff. You might be a profitable trader, even using other stuff. But when you have these types of days and you're trying to work within it, it can be very frustrating. So if you get one victory, one little win, Caleb, and you identify a day like this and you feel like it's like, man, it's a hard read, take it and leave. And don't regret it. Don't look back. Don't even look back at it. Just shake your feet off, shake the dust off of the trading day and then leave it. But it's occurring at 1052. It's trading in that inefficiency. For what reason? It's going down there to offer fair value for anyone that understands the elements that I'm teaching you. Then where does the market trade to? Liquidity, which is that high here, because when it drops down here, the highest high prior to that is here. But what's above that? What I took your attention to on the daily chart, that volume imbalance. So from this candle's low, which is 18,931 even, to this candle's high for the buy side, 5150. So we have 21 handles, or no, 20 handles. Okay, 20 handles. That's enough to do a trade for like a bread and butter type set. I can eke 10 to 15 handles out of something like that. Can you? I don't know. But if you're not confident, don't do it. So to give a better range, that volume imbalance that's shaded in yellow that I got on the daily chart, the low of that, and we'll just ballpark it and say it right here, that's 56. So it's 15 handles. Consequent encroachment, eyeball it, 60. So we're looking at 30 handles thereabouts to get to halfway point, which is right up here. And that's exactly what I said. I would only expect that from Caleb. So being a buyer down here, should he felt inclined to do so, and getting out at midpoint here, and maybe getting filled here eventually, that would be the trade. And then he'd have to move to the sidelines to be content with it. The fact that it's a PPI or CPI number today, and it's doing these type of behavior, I'm not personally interested in taking those types of trades, even though clearly, as I've outlined it today, there are some elements that I can pull out and say, well, here's a setup, and let's watch this. But I'm not going to push the button. There's lots of things all day long that I may be looking at my phone, I may be out and about with my wife or whatever. I'm like, okay, it's going to do this and do that. But when it does it, and it moves 75 handles, 50 handles, 25 handles, like they're happening all day long. But I don't feel like I'm missing anything because I know how to find trades tomorrow. I know how to find trades this afternoon. I know how to find trades in the London session. I know how to find trades clearly in the Asian session. Like I'm not running out of yeast. This baker doesn't run out of yeast, okay? And that gives you confidence, which sounds like arrogance to somebody else that's struggling. And it's not my intention to make you feel that way. But eventually, over a period of time, my students feel that same mutant power, that confidence. And it makes us sound like we're arrogant pricks or assholes. And again, it's just other people that are weak-minded. They can't accept the fact that some individuals have their shit together. And it just feels uncomfortable. They get their feelings all hurt. Okay? And that's the problem with today. They wear their emotions on their sleeve. And if someone's successful and they want to share it to inspire other people, or you ask them and they tell you what the reality is, and then you're like, well, I asked you how you're doing and how much money you're making, and you told me, and now you're a dick. You look at you. You're telling me how much money you're bragging. You asked. Don't ask if you don't want to know, right? Don't ask, don't tell. So at 10:52, we're trading inside the time. That means every hour a macro is in operation. Every single hour. Okay? Some macros are better than others. I'll leave that for the book. But I've talked about most of them already on Twitter Spaces and or other videos on this YouTube channel. There are times where you want to be using them, and others you just want to sit and wait. That's not the right color. Okay, and this would be labeled on your chart 10:50 to 11:10 a.m. Eastern Time. Always Eastern Time. Inside, center. All right. And what we've done is we've highlighted a time when the algorithm that absolutely does exist, it controls price and nothing happens outside of its control unless it's a manual intervention. And you'll know when an intervention is there because it's just completely abrupt, sudden, forceful. You're raped, basically. The market doesn't give you any chance of getting in. It just runs away, one-sided. And if you're in it and you're on the other side of the marketplace and you're offside, you're destroyed, basically. That's a manual intervention. Okay, manual intervention is FOMC. Look at it like that. That's always going on. Every single time FOMC comes out at 2 o'clock and at 2:30, both of those things are manual intervention. They're absolutely controlled demolition. That is not organic. That's not buying and selling pressure. It's not an absence of buyers or sellers. It's not a void of liquidity. It's an unadulterated rape. That's exactly what it is. It's destruction. It's carnage. It's designed to do that. And the sooner you accept that, the better you'll be looking at it and trading after it forms. But at 10:50, for the hour at 11 o'clock, 10 minutes before 11, and 10 minutes after 11, that's a 20-minute interval. Okay? What occurs is the market will seek either inefficiency, like this gap here, or it will seek liquidity. If it's, like, say for instance, we didn't have this gap here. Okay, say this wick touched this wick, or the bodies touched. There was no separation between, and not having this one singular candle traversing between the previous candle's high and the next candle's low. So there's no gap, basically what I'm saying. If that's the case, then what you would do is you would wait for the down close candle that forms in any retracement here. It has to run away from it and then come back down, like we're teaching this order block. That would be what you would look for. But if there's no inefficiency, you have to use the order block. So either it's a gap or an order block or a short-term low. So there is no short-term low in here until that forms. But what's there? The inefficiency. So there's no condition that has all three. You know what I'm saying? Like, you're not going to get a short-term low, an order block, and a fair value gap. That can't occupy the same space in the time frame or chart you're looking at. It's physically impossible. It doesn't work that way. So when students first start hearing these lessons, when I had paid mentorship, they would like, well, how do I know this? And what if it, once you spend time looking at it, they can't all three agree and exist in the same place, not at the same price and same time. It doesn't work that way. It's two at best, but never all three. But usually it's one or the other. Okay, at least one of the three. So there's no short-term low to be worried about trading down below. We do have a gap, but it happens to form after a breakaway from all the consolidation that we were monitoring and I was not interested in all morning here. And I mentioned that we had these lows down here. We swept below that, and I said, okay, I believe that they're going to use the fair value gap that I mentioned here as support. They didn't really technically touch it at all. It was like one tick away, but it then displaced above the high. This gap forms after that breakaway from that consolidation, which is classic algorithmically. It's not classic support and resistance because it never came back down and touched that wick. So at 10:52, we have our first piece of information. Yes, price did trade down in there. Yes, it did not fill that lower portion. And any subsequent touch of the fair value gap high can be used as support. It should be immediate response, take off and leave it, and trade to that high. But how far above that high can it go? You got to go to a higher time frame reference point, which is why I took you to the daily chart to highlight this volume imbalance. It was the easiest, obvious level above this high that's inefficient, because there's no way you can classify short-term buy-side liquidity on the daily chart because you have to go further up. So what's the first PD array that you'd come to on the daily chart? It's this shaded area that I highlighted, which is the volume imbalance. So from entering here at 10:52 into this fair value gap, you have all the way up to 11:10 to see any new entry. So all through this period from here to here, relative to time, okay? This is a time window. In other words, this is what you're saying. In price action, there's going to be opportunities to be a buyer at a discount array. What discount arrays do you see? Institutional order flow entry drill inside this fair value gap that should not fill in because it's a breakaway gap. Why? Because it left the consolidation. Okay. Then we have this down close candle. Does it repel price after? It does. Does it trade above the opening price? Yes, that validates this down close candle as an order block. Is there any down close candles prior to that candle, immediately to the left of it? Yes. Is there one prior to that one? Yes. Is there one prior to that one? No. So algorithmically, the price is called to that opening price because it's the highest portion of these three consecutive down close candles, the opening. That's the price. That's the change in the state of delivery. You extend that through time. How far do you do it? All the way till 11:10. Pray fucking tell how the hell all of this stuff just happens to line up all by time first and price to the fucking tick. There's no algorithm, folks. There's no way they could control price like this. How could they possibly keep things this controlled? 81 million votes my fucking ass. But looking at this, if you extend it forward, trades right back down into that opening price. Bang. Then it delivers higher. If you're trying to get on board and you're trying to work with a macro, because a macro, that 20-minute interval is like a supercharger for efficiency and immediate responsiveness in your entries. That's not to mean that you can't take trades outside of this. So don't think for a moment that I'm trying to say ICT only teaches the trade in the first 10 minutes up to the last, for the first 10 minutes prior to a new hour and 10 minutes after the new hour. I'm not saying that that's the only entry times. I'm saying that as my son, if you focus on these elements of your setups, you're going to get the better fills. You're going to get the immediate response by price telling you, yes, you're on side. How do you know you're on side? When the market immediately starts moving away from your entry and never getting close to your stop. That's a wonderful feeling. How do you get into trades that promote that as a steady diet? Time. Time is the most critical function in price delivery. And if you can't see that, literally you're in denial. You're in fucking denial. At this stage in the game, after me showing so much, you can't see this, there's no hope for you. Just believe it's all random, and don't ever watch my videos. But the point is you have the down close candle here that we walk through the sequence of, okay, guidance tells me that if this is an order block, the way you determine is there's a down close candle prior to that one to the left. Yes. And it does it here. Yes. And then you don't have it here. So you use the opening price there. That's all their algorithm's doing. That's the code. That's what it does. By time, it does this. Okay, it touched here. Why? Why is that important? Because this is the framework that causes that inefficiency. This is where we traded to the low of. So to get this fill perfectly, it's got to offer one tick below it. And that's why it goes down there. That's not fucking buying pressure that stops it there, folks. It's not. The collective universe of buyers and sellers didn't say, hey, listen, today's my turn to be the buyer. I'm going to be low tick today. I'm low tick. Everybody else had a chance to do it, but it's my time. I'm going to be the buyer that gets the low tick on that candle. Think about the absurdity of stating that the buying and selling of everybody out there with all of the shit that they look at on their charts, the things that they believe, the last time their elbow hurt, NQ went up 50 handles. The last time they had gout, the NASDAQ dropped 500 handles. The nonsense. The people that fucking look at the stars and the moon and the lunar sequence and says, oh yeah, Jupiter's in retrograde and this is bullshit. That has nothing to do with these markets. It literally has nothing to do with it. But they'll write books and sell courses and people buy that shit and eat it up. They'll eat it up and ask for more. They'll cheerlead these people on the internet and say, they're so smart. Look at the wisdom. Look at the sorcery. He can read the lunar cycles and it causes the fucking market is not giving two shits about what the fucking phase of the moon is or where the planets are. You're talking about horror scopes. Horror scopes. Okay, I mean that facetiously. I am not following the fucking sun, moon, and stars to pick a trade idea, okay? Because it has no bearing on it. Do full moons cause people to be more aggressive? Sure, I believe in that. But when I read that stuff in Larry Williams' book, How I Made $1 Million Trading Commodities last year, and he was talking about the effects of full moons and what all that, it was an interesting read, but I don't subscribe to it. I don't believe any of that bullshit. Fascinating read at that time, but I hold absolutely no interest in it. And I don't believe absolutely at all that has no bearing whatsoever on what price is going to do. So when we look at price like this, okay, every hour you should have an alarm or you have vertical line. Now, when I say the vertical line delineations, this might be problematic, okay? Because if I do that, you may not see the colors of your wick where the high and the low is. So just be mindful about what I'm about to say here, because if you're not going to set alarms time-wise, like on a clock, say, hey, look, we're 5 minutes away from the next macro. What time would that be on your clock? It would be 10:45 a.m. Eastern time. That means New York local time. Everything I'm saying, folks, if you don't have this on TradingView toggled, I don't care where you live. Your time should be set to this all the time. All the time. Doesn't matter where you are geographically around the world. This is the time that the algorithm runs on. Period. But if you don't want to use time alarms, okay, you can set up little vertical lines framing the macro at each top of the hour. Okay. So it tells you, okay, start looking for a run to gaps or inefficiencies or trade to liquidity. Which one do you do? Well, right here at 1050, that's the beginning of the macro. So what occurred right there at 1050? We've already taken out relative equal highs. So we are engaging liquidity. What kind of liquidity? Buy side. So what is the more likelihood of price going higher at that moment or going lower? Well, we have the short-term low that it forms and then trades higher once more. So we have buy side once more. The inefficiency below the marketplace is where? It doesn't exist in here. All this run up to that high, there's no gap there. All of it's laying over top of each other. This wick here goes back to this low. So there's no inefficiency there for the 1 minute chart. So what does it mean? Sell side if it's going to go discount to here, and or what's that daily inefficiency that's in yellow? That volume imbalance. We went down to it here, we rallied back up, traded down, one more higher high, and then digs all the way back down. What time? 12 o'clock. So that's mid macro. It's like the first 10 minutes entering the last half an hour, or last half of that 20-minute period. So if it's going to be reacting off of that, and if price is bullish, where would it go to at that moment? The price will spool where? To a inefficiency above that. So where's that at? Not here. It's basically overlapping there. You have this one, which is a volume imbalance, which is a smaller form of what this shaded area is that's derived from the daily chart. So you can trade up to that. It does that handsomely. It does this one here again handsomely. And you have all of this here. It trades up to that there. And then you have the liquidity above that high. So it's just like riding or climbing a mountain or rock climbing. This is the surface of the mountain. You just drop down to go into an area, then start going back up. So you have to look at that surface of that rock like a rock climber and say, okay, where's my footholds? Here, all of this inefficiency. How can this inefficiency be used as a foothold? It has to go above it and then come back down in here and then sends price higher again, taking out this high. So price is doing what? It's using this time to refer to key price points. And if you are looking for a directional run, it helps you frame that. Every single hour it does this, which is why I used to brag about it all the time on Twitter. I'd say, look, I can trade every hour candlestick. Every single hour I can trade it. And it's based on this idea here. Okay. All the stuff about 90-minute cycles, I'm telling you for the last time, there is no 90-minute cycles that you can go out and copy and do something with. There's people doing all kinds of bullshit, talking nonsense about it. It's just a measure of, like, that's the smallest window of your trading time. Anything less than 90 minutes, you're not giving yourself a fair chance. Because what that does is it guarantees you're going to get one macro. Very minimum, you're going to get one macro. And if you're knowing what the price is likely to do, because you understand how to read price, and you also understand a directional draw on where the market may send price. That means, what do you think the daily candlestick's going to do? What do you think the session's going to do? What is the weekly chart reaching for? These are all things that we taught in previous mentorships that are being rung back in here because we spend enough time on the lower time frames, proving that you don't need to see all the other stuff, but to get a better view holistically, incorporating the higher time frames, weekly and daily, you get much more information, which makes your trade decisions a lot easier and better. So you can see how these elements of time, they're crucial. They are superchargers for anticipating price runs and how they are to behave, how they function. What's the mechanics behind why a price run takes place? That was what I did a lot of study in my 20s. I wanted to know what repeating phenomenon were there in all of these price runs. And back then, I would be in trades where the market would just take off and start trading one-sidedness. And I would go back through and looking for patterns from the book Technical Analysis on the Financial Markets by John Murphy. And I couldn't see anything in there because he was teaching support and resistance. So why was these prices going down to specific levels that were completely by themselves? They had no rhyme or reason to why it did it. And I collected and I collected and I collected, and I started seeing these repeating phenomenon. And I was obsessive about reading price, studying. I wanted to figure this shit out. I had to know. It was a physical problem for me. It was consuming every aspect of my life. And you can hear it. I mean, I'm here. It's 20 minutes after 12. I was supposed to be out of here 2 hours ago. But this is my life. This is my passion. And it's my baby. So I want to brag on it because she does exactly what she's told to do. And there are times where it can be messed with, it can be tinkered with, it can be disrupted, okay? And when you see those types of things and you understand what it should do and it's not doing that, that's the clearest thing I can say that tells me I'm not doing something in the market that day. And I can't make it any easier or plainer than that. So if it's telling me very clearly that it's trying to do something based on time first, it's reaching for a pool of liquidity or inefficiency above or below the marketplace, then it's going to keep doing that. And either I'm on a trade or I'm not going to be on a trade. And if I'm not going to be on a trade, I don't care. All of this price action, these types of runs here, these are not important to me. They're not interesting to me. They may be fascinating because I'm outlining it to you and why the things happen and how it all stems from that first run out of that consolidation from earlier in the day, and telling you that if it goes higher, I'm not going to be a part of it and I'm okay with it. But there'll be certain aspects to it that I can see that are synonymous to what we look for algorithmic trades. Look at the difference between, like, see how we have 1150 to 1210 here? I'm going to do the same thing for the 1110 to 1050. Okay, so in between these two vertical lines here, the purest, cleanest delivery, how price will spool. Now think about, like I gave you an analogy last week. If you're a fisherman and you cast your lure on your reel, you cast it out, and all that fishing line starts spooling off the reel as the lure and the weight and the hook gets further away from your rod as you cast it out. That spooling, that leaving of the reel as this fishing line comes off that's what's occurring here. It's spooling off of it, running away as it's being cast away from the rod. Okay, look at the difference in between 1050 and 1110, which is what I'm teaching the algorithm does. The real runs start in there, and then after 1050, price can still advance, but look how shitty it gets. All of this, and then suddenly what happens? The algorithm starts going back into what it does, following its code. At 1050, 10 minutes to 12, we get run on liquidity, back down into a discount, sell side, run. Can you see that? And this isn't the most obvious examples, but even on a shitty day like this, you can clearly see something's going on between this time window of 20 minutes. And I want you to study your charts like that. On a 1-minute chart, on a 15-second chart, even if you don't have the ability to do the 15-second chart now, once you get to the point where you can afford to do so, then obviously collect it. If you have friends that are training with you and they have the ability to do 15-second charting, share the chart with them. You're not giving them real-time access. You give them something that's already happened. But this is something that you should be observing and studying, because I've taught about this and people have tried to make courses around it and they have no idea what the fuck they're talking about. They've rooked people, they've scammed people because of something I've said, and they use the buzzwords and they claim that, oh, this is what it's doing, and they talk about all these other macros that aren't macros. They're not fucking macros. This is your macro. This is what they are right here. Now, you do have a midnight to 1 o'clock in the morning macro. You do have a final hour of the day, 3 macros. I've talked about them for indice trading. What you do with them and how to use them and when to use one over the other, that's what's going to be on the book. I've already taught you a clinic today on macros. If I ever stopped and never mentioned macros again, I have given you such an advantage. I've given you a baseball bat, okay, that you could walk out there every single day and smash something if you have a general idea where the market's likely to go. That's the first and foremost lesson, though, which is why I've been beating it into everybody's head and when I teach, knowing where the market's trying to gravitate and draw to. If you don't have that, everything else is going to put you offside and you're not going to do well and you'll be frustrated. But once you understand where the market's likely to draw to, and it has range. What's range? It's got to at least be able to move 20 handles. Because at 20 handles, I can get 15 handles or 10 handles from that. So if I'm not confident that I can see a very simple price run of 20 handles, it's going to be one-sided, it's going to be timeable, where I can go in and anticipate it occurring, then I'm not interested in taking the trade. And I don't care how it trades and keeps moving and moving and moving. I don't care about that. Because I know that there's going to be technical days that's going to be like this that I don't care too much about. And for people that are brand new and they think, well, look, this thing's been going up the whole day. He should have made this and should have made that. I'm not here to prove trading. I'm here to teach my son how to start being able to determine where the market's going to go and where to avoid where it's not likely to be so easy to trade and navigate in. You're going to tell me all this stuff in here? All this stuff is in here perfectly clear to you? Every little tiny little fluctuation, I guarantee you, if you were in a trade, every single instance where it was dropping down, your asshole was puckering. But you're going to talk about it after the fact. I'm not out here after the fact. I'm outlining it and giving the logic as it's happening. So it's up to you to test this theory in your charts. Log it. And then if you don't see where the market's referring to beforehand, there's no shame in getting the information after the fact, because hindsight's 20/20. And every doctor, every surgeon, every fucking lawyer, every professional, every pilot, everybody started learning their trade in hindsight. They looked at hindsight examples. Everything has to be started from the basis of hindsight. And why people pretend that looking at hindsight moves and studying price action like that is not beneficial, like you're going to somehow learn how to do this without doing that, they're full of shit. And because most people come to this industry chomping at the bit to hurry up and run and make money, and they're impatient, that's a huge market to tap into. I could rook all of you easily if I wanted to, and fleece 95% of you immediately. Just by saying, I'm going to give you the secrets to the macros, and here's the course, sign up to it. It's $560. And you only have this much time to join up. And once it's done, I'm done. And not have fucking millions of dollars thrown at me again. Because you've seen enough, okay? You've seen enough to validate the things I'm talking about. You watch me call it live. You watch me explain it, even though it may be at a level of detail and pace that you don't like. But you can't argue the fact that I can see this shit before it happens, and I can tell when I don't want to be a part of something. And if I say this much and I give the buzzwords, and other people know that, wow, there's going to be people that want to buy this shit, and I'm in a country where nobody can come after me if I scam them. So all I got to do is get them to send the money one time. If they never pay again, I don't give a shit. I can pay my bills. I can live. I can eat. And unfortunately, I've had a lot of people all around the world in third world nations scam individuals in those third world nations and lie to them saying, I'm in ICT's mentorship and this is what he's doing. My private mentorship, people barely get shit from me because I have leakers in there. Once in a while I'll hang out with them, but no. So if I'm going to share it and teach it, I'm going to amplify on what they've already learned, which works, because I have students that have made millions of dollars. Find your mentor online selling $200 courses that ain't any millionaire. They've made none. They've made none. And they're watching this live stream right now. Hi, Patrick. So if you're looking at this as a basis of finding when the moves begin or where they originate, this is one of the easiest ways that you can frame out your hindsight moves and start studying them. And then by going through the process of reading all this stuff, okay, notice how candlesticks in and of themselves that are down closed candles, okay, if order flow is bullish, okay, for the sake of benefit of the hindsight that's available here, obviously the market wants to go higher, and we can see that it's done so. But where are you keying up your interest in this? Because if you're trading outside of the 1050 to 1110, I'm sorry, 1150 to 1210 and 1050 to 1110 intervals, you're demanding that you know a whole lot more than you probably do in your skill set, in your progress of learning how to read price action. What I do is I'm putting your focus inside of these specific windows of time where the setups will absolutely fucking be there. You might get the direction wrong because you have not done enough work in determining where price will be gravitating to. You understand? Like, there's a certain measure of responsibility on your part. Like, you still have to go back to square one, which is, where is price being drawn to? If your models don't start with that first foundational premise, everything you do after that or apart from that is likely to fail. And you won't have the courage to stick with any trade idea, because any little fluctuation and return back into this rally up, these are all ugly retracements. They're all shitty retracements. I don't like price activity like that. I like price action that has none of this shit in it, where it runs and creates very obvious one point of inefficiency, a fair value gap, a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. It's easy for me to read that. It's very, very easy to do that. And my students that know how to read the price action and the things I've taught, they can nod their head and say, yep, that's all I do. If it's a day, like, think about it like this. Imagine all these candlesticks are cars and trucks and tractor trailers on the highway. And the highway is from this candlestick here to whatever this price is up here. Say you had the foresight to know that from here to here, it's probably going to keep going up. Okay? And this time of day is 3 o'clock in the morning to 5 o'clock in the morning in your local time. Okay? And then this right here is like 8 o'clock to 9 o'clock, or 7 o'clock to 9 o'clock, when it's rush hour, when you can't go fucking nowhere. Everything's jammed to the gills. You can't do shit. You're sitting out there cussing and wishing you weren't there. I should have called out of work today. I would have left earlier. I should have got gas. I'm going to run out of gas. There's a fucking accident up here. I can't get past these people. They won't let me get past. Nobody's letting me merge on. You're dealing with it. Everybody's dealt with that before, right? Well, look at all the congestion. Even though this move has been going up, look at the congestion of back and forth. You've seen the same guy or woman that's tried to cut in front of you and change lanes 15 times, and she's still within 2 car lengths of you. And she's cussing and ranting and raving, and you're worried about not letting her get in front of you, or letting him get in front of you. And they never find their way any further up the road. That's what's going on back here, all through here. And then all of a sudden, you get to 6 o'clock in the evening. Rush hour in the evening time is over. So the traffic gets cleaner. And then all of a sudden, boom, it starts running. Because there's no congestion. There's nothing slowing down the progress of price delivery. If you're going to trade in environments like this, well, you're going to do something I'm not interested in. And I can tell you right now, nobody gives 2 shits about wanting to trade in this kind of mess here. Nobody's going to put lipstick on this pig and say, sweet, how pretty is that? You're not going to get it. Nobody sees this and says, wow, that's sexy. I don't give a shit how much money you can prove after the fact that you made. You're never going to convince people that this is the right place to be trading if they know anything about reading price. Contrast that with when the market's running real clean. You have nice run-ups, obvious inefficiencies, there's gaps there, and then it pulls back into those gaps, and you can reasonably expect that it's going to be bouncing and trade to another premium array, and then you can judge whether or not if it's going to stop there and go lower. You can swing trade it. This is not a swing trader's market. I guess it's probably would have been better for me to say it that way earlier. I was trying to figure out how to articulate what I was saying. I like a swing trader's environment in intraday, because I can buy and sell, go short, go long in the same trading day, in the same trading session, in the same hour. So if I can't do those types of things, if I can't be like Spider-Man, web swinging back and forth, up, down, that's usually an indication that I'm probably not in a market environment or session that is conducive for me to be comfortable. Can I squeeze something out? Clearly, as I outlined over here, I could have very easily pushed a button on that and said, see, here you go. But I'm practicing what I preach and what I live by. If it's a condition that I don't like, I'm staying out of it. Why? Why am I? In the past, I've done things like that, where I said, I don't like this, and then all of a sudden, I'm not going to trade, and then I go out there and trade and make 150 handles. That's because of some asshole leaving a comment saying, "Oh, you can't trade today because blah blah blah," and then I got and smoke them, and I do their whole 3 months of whatever they pretend they did. I did it in one day. But because it's my son that's the real target audience here, I'm practicing what I preach because I want him to do those same things. I want him to be humble. I want him to know that I've made mistakes doing these types of things, and also where dad has a little bit more difficulty using these like this as a canvas to operate in. I can paint whatever I want in terms of the haul or profit objective I want for the week. I don't have to be in every day seeking to do it. So I want to be aware of what I'm saying in the presence of my son's attention, because I don't want him to gravitate to the things that seem sexy, attractive, action-packed. That way it draws attention for the sake of drawing attention. I want him to be bored when he does this. Not that he's so bored he doesn't want to do it, but because he's not influenced by fear and greed. And that's a very delicate thing to balance. And I didn't know how to address those things when I was a 20-year-old, but I was teaching then. And I wasn't prepared to be a teacher. I didn't know enough to be teaching, but I was charging people money in my 20s because I had initial success that was completely blind luck. I could not do what you're able to watch me do today then. I couldn't do it then. I can do it now. And my maturity and my affinity for other people and concern for other people, because I harmed myself with these markets too. It hasn't always been good. In my 20s, it was a wreck. It was bad. It was really bad. But I want my son to be spared of all that. And he can take all the advantages and the painful lessons I learned and do the right things, speed up his learning. Not that I want to make it faster, but this is the way you speed it up. It's the only way it can be sped up. The learning curve is shortened by you learning initially in the early stages how you're going to probably mess it up. And 90% of those things are you yourself. You're the catalyst that causes those things. It's not poor information. It's not incomplete lectures. It's not concepts that don't work. It's you doing things that were not taught to you. You're trying to reinvent it, trying to do something different, or you're not following the rules at all. And if you can't do those two things, you can't reasonably expect to be able to be productive and profitable in your learning, or eventually being profitable in terms of making money, because you're not doing all the things you're supposed to do. So tomorrow, we're going to talk a little bit about turtle soup. I was going to talk about it Friday, but I lost my train of thought, and because my son was sitting next to me, and it's just it wasn't a good fix. I had limited time. I wanted to leave early anyway, and it didn't work out. So tomorrow we're going to talk about turtle soup and reversal patterns, around that same subject matter. But I'll give you my view as prices, real time producing its runs too. But the main focus tomorrow is going to be teaching turtle soup. So it's a reversal program. It's a reversal pattern idea. It's a methodology for capturing reversals, and I think you'll enjoy it. There's not a great deal of moving parts, but the logic is very simple, and when to look for it, when not to look for it. Kind of like I spent a great deal of time today highlighting personal attributes about days like this, where I'm comfortable being in front of you, telling you that it might go higher, but I'm not interested in being in this market, because I know that this one singular candle isn't the entire encapsulation of my trading career. It doesn't limit my opportunities, because this is the day that I'm watching live with you. Just look at what we were doing last week. Look at what we were able to do yesterday. So unfortunately, when I do live streams or I talk about price action live when I was on Twitter, calling every individual candlestick before it happened and what it would be reaching for, the idea is that, ICT is always in there every single day, killing it every single day. And I'm not. Many times if it's around a report day like this, if it behaves like this, I won't touch it. Like, I'll talk to traders online. Everybody obviously has my phone number because it's public knowledge, and I have students that shared it, and I have people that trolled me and sent me nonsensical bullshit. But I do communicate with people on the internet that are traders and are YouTube traders, the live stream and whatnot. And sometimes we'll check in with each other and think, how'd you do today? What'd you do today? Or if someone had a good day, I'll congratulate them. Or if they had a bad day, I'll say, what would you like to do differently if you could go back and do that? Now, obviously, I wouldn't come out of the blue and send that to anybody as a first text, but I believe I've built a rapport with certain individuals, and they're very cordial with me. They'll say, well, I did this, or I didn't do this, and blah, blah. And I like seeing that. I like seeing that they're flexible enough to say, this is what I would have liked to do differently, but they don't beat themselves up about it. I like that. And if they try to, I kind of reformulate their statements in a manner so it's like, yeah, I get what you're saying, but say it like this. That way it doesn't feel like you're whipping yourself in the woodshed. But anyway, this is one of those lectures and lessons that I honestly would have paid fucking money for this. Like, I would have paid money for this. And if I would have paid money and I had sat through this today, I would have got my money's worth and more. Because having gone through initial stages of thinking I figured it out when I was 20, and then losing my ass, and then not knowing what it is I'm supposed to be feeling or how to identify certain times of the market where I'm not interested in trading. And I have no shame in it. There's no ego. I don't have there's nothing that I feel as a embarrassment saying this. And I hopefully have disarmed many of you that probably feel like that's bothering me. It feels like, I don't want to admit some frailty. I want everything to be like, I'm Superman. Like, I have no weaknesses, but everybody, even Superman, has a kryptonite. And the sooner you warm up to the idea that you're not expected to be perfect and you don't have to trade every single day, that is such a very liberating frame of mind. It's very liberating to feel like, as a constant reminder, before you start trading, you should write it down in your pad that's next to your computer, not on your screen, and remind yourself, if it doesn't feel right, and if it doesn't look right, and if I don't recognize it, I don't have to trade. And if live streamers did that, you wouldn't see them lose as many times as they do. And there's nothing wrong with losing. I'm not making a sharp-pointed statement, but I believe wholeheartedly, and the ones that I talk to know what I'm saying is exactly what I've talked to them about. They do things many times because they sat for a long period of time and they have an audience. And that audience is in the chat window, and they can say they don't want to look at every chat, but the times they feel uncomfortable because they know they haven't pushed a button, they haven't done anything, they haven't explained anything, they haven't called something before it happened, they know that the natives are getting restless. They want to see something. They want to see something. They've been there. They've invested their time watching you, listening to you, looking at your live stream. And what have you done? In their mind, you've wasted their time. No, they wasted their time. Any of you sitting here today, if you didn't get something from this, you wasted your time. I didn't waste my time. I've invested into my son with things that are absolutely grounded in making or losing real money based on real executions and the lessons I had to learn painfully. Painfully. And it took a lot for me to wrestle myself into submission, saying, okay, if I see these things, I'm not trying to prove myself in these conditions. I'm not trying to do that. I don't need to do that. In the past, I've hurt myself doing that. So I want to focus where I shine. I want to be visible when I know I have all of the things in my favor. And if I choose to operate all my trading like that, guess what that does? It refines you as a very mature, principle-oriented investor and trader. That means you're not out there just pushing the buttons for the sheer gamble and thrill of it. You're weighing out all the ramifications of your decisions. You're not limiting it to just a dopamine hit if you did it right. Are you really following a model? Because if you have a model that you're following, it's going to have certain measures of criteria like we're talking about here. There has to be something that frames a day that you are not allowed to touch. It cannot be open season every day. So the people that say, every day is a trading day, every day is a profitable day, you're listening to a gambler, period. Okay? They're training you to try to go in there on every instance, every single day, because the market's trading, therefore you should go in there. No. Should you be in there engaging and studying price every day? Absolutely. But you should not have the mindset going in, you don't know what you're doing. You've never been profitable. You're learning. You should not have the expectation of going in every single day. No way. Absolutely not. No way. You're setting yourself up for unrealistic expectations never being met. And I know that isn't sexy to say those types of things, but that's the sound logic that a new student should adhere to in the beginning. And then when you finally get your model, you may have another model in addition to the one you subscribe to and use predominantly, but you'll have a very specific routine that you use that if it meets the criteria for trades, then you'll take it. When you take a step back over years of doing it, you're going to look back and say, you know what? That old motherfucker was right. He was talking truth, and I didn't want to receive it then because I want to trade every day. Because everyday trading is a legend, is a goat. I'm not trying to be a goat. I'm not trying to be a legend. I just want to be consistent. And I want to live my life and know that what I'm doing isn't going to drain me emotionally and psychologically. I'm not going to have regret. I don't like gambling. I hate gambling. If I liked gambling, I would play cards and I would probably win because I can count cards. I can run the cards up. I can stack a deck. I can do all that kind of stuff. I have built-in advantages, but I don't want to gamble. I don't go to casinos. I don't play the fucking lottery. Okay. I don't do none of those things. I don't do that stuff. But I do very boring things like watching these candlesticks behave at a specific time of day in an environment where it's conducive for it to be recognizable. That's it. And if you can't let the market pass you by and you feel like, man, I'm missing so much, that's highlighting impatience and greed. And those two things together, they're deadly. And you have to master them early. And that means by watching price and giving yourself permission. I'm not going to try to trade. Even if this thing keeps going, I don't care. Because the visibility is beyond just today. Caleb will not be able to trade every single day. His job won't allow for that. So a lesson like this helps him to ground himself, knowing that, okay, just because the market is trading and just because there are fluctuations in price and it's moving doesn't mean that I have to be in that day, because his schedule, his workload, something else happening may prevent him from doing that. And I don't hear enough of that taught by these pseudo mentors, these educators. Everything's go, 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 go. Everything's maximum, maximum, maximum. Everything is trying to make money, make executions, make trades, get payouts. Not realizing that these same individuals are making money off of you doing that and not being successful. Because every single time you use an affiliate link, they're making money. And I mean that not to be vilified, not to, throw hate at them. I'm not throwing shade or anything. I'm just making you remember for a second. If the constant reminder is go, 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 baby, well, don't be surprised when it's gone in 30 seconds and you have to pay another reset fee. It's a built-in advantage for that. It's a built-in advantage for anybody with an affiliate link to get other people to do these very poor choices. Go out there and trade. I can teach you how to trade in X amount of days, 3 months, 4 months, 1 month, 1 week. 1 week workshop, one weekend, spend a weekend with me and I'll teach you how to trade. Come on. At some point, you're going to have to take a step back and say, okay, where's the motivation here? If I had an affiliate link with people, any one of these brokerage firms, and most of them have asked me, and I'm like, no, I won't do it. Can you imagine the influence that I have? And if I said, listen, here's the affiliate link, I could probably make millions of dollars doing that. And I'm not here doing that, am I? I'm spending time. I read a comment from a young man. I do need to cut off here because I got to get something I haven't eaten today. He says, you know what? I like listening to you. And I love your long ones because it feels like I'm his dad and I'm talking to him like a dad. And it's because as I'm talking this stuff, I'm picturing my kids and I'm picturing Caleb as I'm obviously doing these live streams because that's my target audience. But I liked his comment where he's like, I like the fact that you are spending time. I live comfortably, okay? And when I said last week that I'm a millionaire, that was not me bragging. I'm just reminding folks that I don't have to go to a job. I don't have to I don't need to trade ever again. Like, I never need to do this ever again. I don't ever need to press a button and hope to make money. I don't need to do any of that stuff. But he says something that I've said this many times in passing when people would be upset with me because I wasn't doing enough. He stated that he's thankful that I'm in the position I'm in and I don't have to make this available to you. Like, I don't need to spend my time in front of you. But I think you can appreciate that I enjoy it, right? Like, I love doing this. Like, I love it. And really, I'm not getting a lot. There's the ad revenue, that's not a lot. Like, it costs a lot of money to live like I live. I spent $30,000 on my lawn in the last 45 days because of the drought and the things I wanted to get done. I had some lighting put around the outside of the house. That's $33,000 I spent. $3,000 plus of it was just basically paying for the lawn care each week. But everything else was stuff it's been done to my home. Okay, I spent over $100,000 in the last, 9 months just for things for my house. And my wife is constantly looking. She's constantly looking for shit that we don't need. Okay, so I don't need this for money, but I do enjoy doing it. And once I start doing it, because it's my whole life, I enjoy doing it and I want to pour myself into it. And because I want my son to have every aspect, every subtle nuance, that's why it's here. So when you send me comments for the few little soy boys that do this, say, you talk too much. You talk too much for a grown man. I broom you because you're insignificant. You're a nobody that's never going to be successful at this because you can't appreciate complete understanding being shared with you. You can watch everybody else out there. They're not going to explain to you why and when it's going to happen. You're not going to get that. They might get lucky once in a while chasing a momentum run, but you're never going to hear them explain beforehand why it should do this and it be this precise. You won't hear them explain why they don't like a certain market condition because that means you're going to be doing little or less or not watching them. I don't care if you watch my stream. I don't give a fuck. I don't care if this viewership drops down to 1 because that's my son watching. He asked for this. I didn't ask for this. He asked for it. So I'm pouring myself into this. And he'll tell you, if any one of my kids were to be candid with you and say, look, we don't like asking dad questions because it's going to take an hour for him to explain shit. So it's not just this. If I know something, I'm going to make sure you had enough interest to ask me, knowing full fucking well that I am a mouth. I will talk and talk and talk and talk. Not because I like the sound of my voice, but because I want you to know that you know. You asked. If I understand it and I know the question and then I know the answer to it, I'm going to pour myself into that. You're going to know. You'll never need to ask that question again. But now he's asked about trading and the markets. So yes, Virginia, we're going around the mountain the long fucking way, okay? Because I want him to know everything. because tomorrow is not promised to me. I could be taken out of here tomorrow. Lord says, you know what? It's done. You don't even get tomorrow. You get today. That's it. He could take me right now. And then he's only got everything I've ever recorded in all of my journals. And those journals are not going to be decipherable by just reading them. I can place them in any one of your hands and you're not going to understand shit, because the language that I'm using in it is not something I taught to you or anyone else. So it's not something that it's an easy download and it's there. He's got to go through the same growth that any one of you have gone through. The difference is I'm not holding back anything. Whereas I've held back a lot because it's been abused. It's been marketed by people to make money. Some asshat still trying to sell mentorship videos when it's still right here on the YouTube channel for free. And the people that paid that person are stupid. They're fucking stupid. Like, if you're literally paying anything for any smart money concepts, ICT related anything, if you're paying for that, you're an idiot. Like, I'm literally here right now teaching over live data. And I've uploaded the mentorship videos on the YouTube channel. They're in the playlists. I don't get it. And there's people email me every day. Can you do another paid mentorship? Why? I'm doing more than I did here than I did for them. Let it sink in. I'm literally doing this with no reservations. I'm telling you what's going to happen, how to use the information, very specific elements to the macros, to the inefficiencies, how to get the bias. That's a straight shot. And I still have people, can you tell us how to do a daily bias? And that's all I've been teaching thus far. You know, what are you listening to? But anyway, we're on 1 minute chart. Let's back out of this, go up to a daily chart, and I'll take one quick peek at it, leave you with any commentary in regards to where it might still reach for, and then we'll close it and I'll have lunch. Alrighty. So here's the volume imbalance I took your attention to earlier. We've traded to that and through it. This up close candle right here, you want to measure that to the high. Okay, so that's mean threshold. So 19,255, I'm not saying it's going there, but let's just say that it wants to keep going higher and go beyond the previous new week opening gap, which is high, that high here. You see it right there, where we stopped trading and we opened the next trading session. That's, you can see that level here. That's a level to look for to trade to, and then the middle or mean threshold of that up close candle prior to that drop down, that midpoint right there. Now, if we start exploring anything above that 255 level, then they're going to want to run this high. And where does that leave us? This right here. That's a huge disparity between where we closed here and where we opened there. That's a huge gap. So longer term, if they want to pump this up, and it can happen because it's an election year, barring anything really catastrophic taking place over in the Middle East, it would be reasonable to see it want to take this high and maybe even go up into this area here. But I'm not demanding that. I'm not holding for something like that. But for the sake of just pointing your attention to something, because, you know, without any real bad news, without any mushroom clouds popping off, you know, any terrible things like that occurring, they're going to try to keep pumping this up because it's in their vested interest to make it look like the economy is good, and everybody thinks the economy is measured by the stock market, and it's not. They're not. That's not a real value. The volume imbalance here, that would be the highest extreme for this year at the present. Right now, looking at the chart, if it were going to go up from where we're at now any higher, the highest that I would want it to go to and feel comfortable and reasonably expecting it to do so would be that volume imbalance right here. Okay. Am I saying it's going to go there? No. I'm saying for the folks that have asked this question because they can't trade with intraday charts, they want to know this if you were looking at the daily chart, how far can it go? Because they can only trade longer term and they use a daily chart. So for the people that are bitching, complaining about this stuff, saying, why are you talking about this? I don't care about this. You're not my only student. And for the people that take the time to write that kind of stuff, I never get to see your comments again. So just know that you can say anything you want in your last day because I never see your stupid shit again. But liquidity rests here and volume imbalance is there. And I think that's it. This is all based on the fact that we didn't see anything pop off with Iran and Israel to a greater degree. That's what this is. This is kind of like a relief. It's just being organized in sentiment that, okay, everything's safe right now. Does it stay that way? Who knows? All it takes is the right thing dropping in the right place and all hell breaks loose. So barring any of those types of things, we're probably going to keep pressing up and challenging, the midpoint of that inefficiency, and therefore just stick with the underlying narrative and don't try to fight it. Otherwise, I will be back with you all again tomorrow. I do not absolutely want to spend this much time tomorrow. I know some of you complain that the videos are too long and you can't digest them because it's too much because you work and you have a life. I get it. But remember, I'm not here for just you. I'm here for a complete overview, a complete rundown, everything, because it's my son. That's who I'm talking to. It might feel like I'm talking to you, but I'm talking to Caleb. So you're just here listening. You're eavesdropping. You're eavesdropping by invitation. Just remember that. So you're a guest, and you don't get to tell me what you want. You can, but I don't need to ever see your comments ever again. But that's why it's a long way around the mountain, because it's my son asking, and I want him to have all the details, all of the ramifications that will be met by him in his development, all of the circumstances that will feel daunting, all the things and how to get around it, how to cope with it, how to feel normal in it, how to look beyond it. That's what I'm including. This is me mentoring my son. And I don't want insight from any of you because I don't care to know what you think I should do. You're not going to give it any better than me. I'm who I am, and I'm his dad. So no one's going to have the right answer beyond me. So while I appreciate your enthusiasm and trying to feel like you're having an input in it, you don't get an input. You just get a seat to sit here and watch it, and nobody's twisting your arm. So that's going to be it. I've had fun. I've shared a lot of stuff today. I think I've communicated rather effectively that you don't have to do something every single day. You don't have to know everything if it's going against the grain that you are outlining for your model. Be flexible with yourself. Give yourself permission in the beginning and just relax. After it happens, after it forms, go back in and study what was presented and hold nothing over your head as a punishment saying, well, I should have saw that. Because in the beginning, you shouldn't. You're learning how to do that. And over time, you'll pick it up. I promise, son, you will get this. But you have to take things bite size at a time. And eventually, you'll have more experience. You'll start finishing my sentences like you do when we're talking about the Bible. And all these things will start to become second nature to you. And when it's like that and it's boring and you're not in a rush to get in there and show dad that you can do this, that's a huge goal. But we're not in a rush to get there. Don't think that I need to see that anytime soon. But that's where we're aiming for. We're aiming for you knowing where the market's going to go. Once we get there, then we can start fleshing out some more stuff. But until tomorrow, 9:15 or so, Lord willing, I will talk with you all then. Be safe.